Asset board for you and show you what we've come through in Asia. So this is the bruising that Tom's talking about there. MSCI Asia Pacific down by 1.6%, following on from weakness on Wall Street yesterday. The market adjusting to higher for longer, even if the dot plot suggests that many are hesitant as to whether they think the rates will stay as high as the Fed does next year. Nasdaq futures down, suggesting we've got further to go on the negativity surrounding higher for longer, down 0.3%. Two-year yields. I put the two-year US Treasury yield in here because actually we're seeing some movement there. There's sort of an outlier versus the rest of the Treasury curve and also versus Europe, where we're seeing actually yields go higher. Here we've got the Brent crude price down by 1%, 92.57. Worth noting because we made such a fuss of the rise, Tom.
That is worth reflecting on. We'll break out the sectors, of course, and focus on energy in just the next few seconds. CAC futures putting the biggest losses right now of more than 1% over in the UK. The FTSE 100 pointing lower by 64 points, Anna.
OK, so we are expecting then that negativity on Wall Street into Asia to spill through into the European session this morning. We'll see if that is what is delivered at the start of trading day. Here's the FTSE 100 then opening on the back foot, down by 0.3%. The dollar continues to gain. This was yesterday's move, of course, post the Fed. We saw the dollar gain. Have we actually not seen the top for the dollar in that most recent rally? July, August were very strong for the dollar, made a lot of people ask whether we've seen the top. Actually, it continues to rise, so up by 0.1%. The pound and the euro take the other side of that trade. 123.24 on the pound as we head towards a Bank of England rate decision later on today. This is the rest of the European picture then. The French market certainly taking the worst of it so far, down by just over 1%. The Italian FTSE mid down by 0.8%. So broad-based selling in terms of the geographies across Europe. This is interesting, the way that the sovereign bond story reflects the 10s, 30s part of the curve over there in the United States. So we are seeing selling, we're seeing yields going higher. That was, again, a reflection of yesterday's post-Fed story. The two-year Treasury actually going its own way and doing something a little different. But this is a consistent story, the higher for longer narrative working its way into the European markets. And here's commodities reflecting concerns about growth, perhaps, or maybe it's the dollar move. A lot of factors to think about when it comes to the commodity story. We rallied so far, Tom, on that supply concern from OPEC Plus, now pulling back a little, down by 1%, just over 1% on Brent and on WTI.
So every single sector here, apart from retail, currently in the red. And on energy, you're seeing losses of almost 0.9%, just reflecting the downside that we've seen in terms of Brent on the back, and WTI on the back, of course, of higher yields and stronger dollar. But there's also a lot of pressure coming through on the tech sector. That ties, of course, to the yield story. We've been talking about the fact there's been a bit of a catch-up in terms of sovereign debt and yields edging higher in Europe. That catch-up, of course, from the US session, when yesterday the two-year got to those 2006 levels in terms of the move up in yields. So clearly, higher yields, a pressure point for technology in that sector, down a little over 1%. Basic resources taking a big hit as well, off by 1.5%, even though the real estate part of the market in China seemed to be getting a little bit of relief. Property measures still coming through from officials there, but basic resources not lifted on the back of that. 1.5% is the downside for that sector. The consumer is also being hit in terms of that sector, down a little over 1%. And industrials in similar territory. Travel and leisure also off by 1.2%. But the standouts for me right now are energy in the context of the run-up in prices we've seen and the upside you've seen for that sector. Basic resources a big hit there, and tech as well on higher yields.
OK, so that's the picture. A lot of red on that screen then, Tom, in terms of the sectors today. Sophia Holter-Acosta joins us from our Markets Today blog with some of the themes that are really dominating coverage on the blog today. And one of them, of course, has to be, Sophia, the Bank of England. We were talking about this a little earlier, about the expectation and the way it's really shifted just in the last 24 hours. 23 hours ago, we had the team standing here, in fact, 25. Let's go in the right direction, Joey. 25 hours ago, breaking that inflation number. It came in much weaker than expected. expected, and that's caused a lot of rethinking around the square mile.
A big shift in market sentiment and market positioning yesterday. So now it's a coin toss. I mean, that's such a big move from the 80% probability of a hike that was priced into the market. We really saw that move in rates and in the pound. Also putting pressure on the pound is, of course, kind of that divergence in policy with the Fed. I think that's, again, prompting bearish traders to kind of reload their positions ahead of the BOE decision. I do think this could be a really interesting market move in either way, because although it is a coin toss, you did see people kind of really buy into those bearish pound positions. The pound is really near the lowest in 5 months right now. The FTSE, I'm surprised it's lower because it does tend to benefit from a weaker pound. That could also be related to kind of just the risk-off mood generally in markets. It's not a good start to the trading day, and I think the BOE could just throw a whole lot of volatility to the market again.
Yeah, and that volatility could be pronounced in gilts, where yields are playing catch-up to the US session, of course. Yields edging up 5 basis points at the front end on the 2-year after having moved significantly lower, as you say, yesterday on the back of that softer than expected CPI print. On the US then, it seems like, at least in the session yesterday, given the downside that came through across equity markets and stronger dollar, higher yields, that markets were waking up to the idea, finally, that higher for longer, the rhetoric is being matched by those policymakers actually putting their thumbprint on the scales when it comes to the dot plots. But project out to 2024, and there's still the disconnect, because 5.1% is where the dot plots are suggesting you end the year next year in terms of rates, and 4.75% or thereabouts is where the markets see it. That disconnect, and how you think about that for the Fed.
Yeah, so I woke up this morning and I was a bit confused about the market reaction because, I mean, there is a pairing, there has to be. Those two things just have to meet, right? There has to be either expectations of rate cuts from the Federal Reserve next year are pared back, and we're seeing that a little bit in equity markets, but not so much in rates, or, you know, the Fed communicates it differently. But I do think, you know, if the Fed paused because the economy is strong, but we did see Jay Powell kind of use cautious and careful, I think he used those words, you know, more than a dozen times yesterday. That really kind of almost softened the hawkish message, and I think that might be confusing traders kind of in the next few months. Is the Fed actually confident about these projections, about the fact that they do think that the economy will be more resilient than the market expects, or, you know, or are we actually going to kind of get a rethink further down the road? And I think that's why we still have that disconnect, Tom, between what the market thinks and what the Fed thinks.
Sorry, I was going to say, Mr. Cautious, this is an important point, Anna. Mr. Cautious, as in the Mr. Men, is what some were suggesting on the back of that repeated repetition from Jay Powell around cautious and uncertain.
Do we spend too much time in children's literature? Do you think that's what's going on here, Tom?
Just maybe blame the 7-year-old for that.
Yeah, that's where our reading is these days. Let me ask you about, I mean, one of the things that has supported the FTSE recently has been the rally in oil prices, and that looks as if it's been damaged a little by what we heard from the Fed. Risk off certainly yesterday took commodities down with it, didn't it? We saw commodity prices drop. I mean, that's something that we'll watch from a London perspective.
Yes, we will. I mean, BP and Shell, big heavyweights in the FTSE 100, and that had kind of supported the index compared to other indexes in Europe. It did reach the highest since May yesterday. So, you know, the FTSE is an oil play. It's also a weak pound, strong dollar play. The outlook for oil is a little bit complicated because it's a supply story, but it's also a demand story. Are we going to get, is the China economy, you know, going to really kind of sputter again, or is stimulus actually working? I think there's still a few questions around there. But $100 oil, that was almost a certainty a few days ago, and now the market seems to not be so sure about that anymore. Cautious, to use the term.
Today's word.
Let's land back on cautious. $92.59 currently on Brent, currently down 1%. I should clarify that my 7-year-old is not you reading, Mr. Men, but she has fortunately moved on from that.
You've struggled to.
Thanks to her mother's genetics, and not mine. Right, Sophia Horta-Acosta, thank you very much from our markets today. Yes, I'll just reflect on the fact that you've suggested I'm still in the Mr. Men book.
Sorry.
Thank you very much. Not thank you to Anna, but thank you to Sophia. You can get more, of course, from the team on the front page on all things children's books and these markets. Type, of course, T-Live Go onto the terminal, check out the blog. Let's get more on some of the individual stocks on the move with Joe Easton. Joe, what are you looking at?
So the worst performing stock today, Tom, is actually Ocado, which has had a big downgrade over at Exane BNP Paribas. They cut the UK online retailer to underperform. Now, they only upgraded it 2 months ago, and they say the decision to upgrade the stock was akin to picking a fight with a nightclub bouncer, according to their analysts. I think we can all relate to that one. But they say that they are seeing volume declines in the retail business, and also the exit of the company's robotics CEO bodes negatively for that side of the business as well. So that is the worst performing stock on the Stock 600 today, down around 6%. We'll stick with the rating changes for now, as we've got Merck rising in Germany. They get an upgrade over at Citigroup, who say that the firm's head and neck cancer drugs should help it raise their revenue guidance at the next earnings report. So that one outperforming in Germany. And then Beazley, the insurer, gets a price target upgrade at Morgan Stanley, who likes their cybersecurity business in terms of insurance on some of those parts of the world. And finally, TUI gets a rating upgrade to hold at Jefferies, who says that the UK consumer is showing no sign of cutting back on hotel spending, so they're choosing an early checkout on that rating there. Then in terms of a couple of the UK earnings that we had in stocks to watch, we had our eye on Next and also JD Sports. Now, I'm hoping we're going to get those up. There we go. Next, up 1.3%. They do raise their guidance for the third time since June, but the big gainer is JD Sports, up 6%. Now, they did see some weakness in the US, but they said their 7-week sales, their most recent sales, is actually in line with expectations. So that's reassuring analysts that we're expecting a negative report following downbeat updates from the likes of Foot Locker and also Dick's Sporting Goods over in the US just a couple of weeks ago. Ahead of that BOE decision, which, as Lizzie was saying earlier, is on a knife edge now. Lloyd's edging down 0.4%, along with Barratt Developments and a couple of other home builders now up around 0.1%. But those stocks jumped yesterday following that weaker than expected inflation data, so giving up some of those gains on a few of those stocks. Finally, in terms of the delivery shares, bit of a mixed picture on those ones. FedEx jumping last night, but mostly driven by their cost cutting. There wasn't too much of a reader cost. They actually reported their sales in their express parcel business down around 9% in the quarter, so seeing some small weakness in DHL and also IDS. The other two, bpost and Post Italiane, not doing too much at the moment, but delivery shares in focus after FedEx's report.
Thanks so much, Joe. Joe Easton from our equities team with a briefing on all of those movers this morning. Let's have a look at what we're watching out for on markets today. It's another big day for central banks, of course, an intense 36-hour period at 8:30 a.m. UK time. The Swiss National Bank will deliver its latest rate decision, so that's in 20 minutes' time. Most economists see a quarter-point increase to 2%, likely the SNB's final hike of the current cycle. Then at noon here in London, it's the BOE's turn. Wednesday's unexpected drop in inflation has given the central bank plenty to ponder. Will it hold or will it hike? Over to the US later at 1:30 p.m. we'll get fresh jobless claims data. That's followed by existing home sales later at 3 p.m. And Mark was drawing our attention to some of that US data, which maybe unfairly is overshadowed by the central bank conversations, Tom. And also should mention the Riksbank. We get the Riksbank decision during this program as well. And there's a fascinating story there around FX and around the housing market, so lots to reflect on.
There's been a lot of pressure, hasn't there, on that housing market, and something of a canary in the coal mine for many across the continent of Europe in terms of the pressures on housing markets and the ripple effects on the back of higher rates. Coming up, though, Fed Chair Jerome Powell says he is nearly done hiking, but his colleagues have signalled that rates must stay higher for longer. We're going to bring you more analysis of yesterday's rate decision. That is next. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Or other authorities
could face bigger challenges.
Britain's next
was going to keep Rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that.
That was Fed Chair Jerome Powell giving his thoughts on the prospect of a soft landing during his press conference yesterday. Joining us now for reaction is Dale Winner, lead portfolio manager for the Focus Global Equity team at Allspring Global Investments. Dale, are you convinced by this hawkish pause?
Good morning. Thanks for having me. Yes, we're in the hawkish camp for sure. We believe that inflation's sticky. There's a lot of structural pressure from decarbonization, deglobalization, structural shortages in commodities, sticky wages. So higher for longer for inflation, and this is maybe getting close to the end of the hiking cycle for most banks, but we're nowhere near the beginning of the cutting cycle. That's really important.
Okay, and do you think the market, good morning to you, Dale, do you think the market needs to catch up with that thinking still then? Because we saw some hesitance. For example, we look at, in fact, the work function on the Bloomberg terminal, and it shows that the market hasn't adjusted its expectations for next year in the way that the dot plots show. So does that mean that the market still needs to adjust its thinking to stop expecting quite so many cuts next year?
Absolutely. The market is behind the curve for sure. We don't see a cut until the second half of next year. And if there is a cut, it'll be because there's a slowdown. And so we're definitely in the high probability of a recession in the US. The 3-month 10-year inversion has predicted the last 8 recessions. No false signals at all. It inverted 11 months ago, and the normal timeline is 12 to 16 months. So we should expect a slowdown in the next 6 months because of the tightening.
So you still think we take signals from the inverted yield curve, even
Absolutely.
though there's so much central bank ownership of fixed income?
I also think there's a cry wolf sentiment as well. People have been talking about recession for the last 12 months. It didn't happen. So, but the most important thing for us is there are no big structural imbalances. It's not a big hard recession. Housing supply strong, consumer strong, banks are very well capitalized. So it's about magnitude and duration. So we believe there's a shallow and long slowdown in the US. That's what's important. That's the differentiating factor.
Okay, a shallow and a long downturn for the US. How are you thinking about equity market resilience then in this scenario? Year to date, of course, the gains have been decent, particularly the NASDAQ. You've had a little bit of flatlining over the summer period, and now the downturn on the back of this hawkish pause from the Fed. In an environment where rates are higher for longer, or you get a recession, both scenarios seem to be, on one level, pretty negative for equities. How much more downside do you think is coming through for equities, or is there some resilience there?
I think there could be some volatility for two reasons. Short-term, negative volatility. And mainly the spike in yields is very concerning. We're seeing 2 years and 10 years at a 15-year highs. There's some technical problems in the government bond market. We have more sellers than buyers, simplistically. Yields are spiking, and we're seasonally at a very volatile time of the year right now. So there could be volatility right now, and we're looking for more idiosyncratic type themes. We think Japan is very interesting. Japan wants inflation. Inflation's good, Japan. They've had 3 decades of deflation. So in this higher for longer,
inflation now. It's getting some.
Absolutely right. So they've had the highest wage increases in 25 years. But 54% of household assets are sitting in cash. They've had 3 decades of deflation. So 50% of banks have net cash in their balance sheet. So we think that Japan is an inflation hedge. It's very idiosyncratic. It's very cheap with lots of catalysts.
And lots of catalysts. Do any of them come tomorrow?
Not tomorrow, no. But we're having, we think that economic growth for Japan could be getting close to the US this year and next year. It's the only large developed market country still having reopening potential. It's got a very cheap yen, very good for exports. But the biggest catalyst for Japan is improvement in corporate governance. And the TSE did a public shaming of companies trading below book value. So half the topics trades below book value. And we've seen a dramatic increase in dividend payout increases and stock buybacks. So you have economic growth, earnings upgrades, and you have a corporate governance change on a cheap market.
The corporate governance story is real in Japan, isn't it? I want to get your views on the UK, but just briefly on a pushback to that Japan thesis, the strength coming through from China's automakers, we don't talk about the strength of China's economy because it's frankly not there on the headline basis, but the EV sector is booming, and that's a challenge for the automaker, the industrial hub of Japan. And you layer that on with the softness of China, and that's a drag on the other components that feed into Japan's strength as well. So that would be the pushback on the outlook for Japan.
It's a pushback on autos. We don't own any of the autos. We own domestic financials. The domestic financials will be massive beneficiaries of the end of yield curve control and the end of negative interest rate policy. Now, I just said negative interest rate policy. So the Bank of Japan still has negative interest rates.
Believe it or not, that's still where we are. And we certainly saw the European banks benefit when we stepped away from negative rates where we had them in Europe in months past. Let me ask you about the UK then, Daryl. We'll get to that conversation at last. Interesting that we've gone from outlier status on inflation in the UK to back into the pack a little bit, just based on, if you look at what's going on in core versus Germany, for example, core inflation versus Germany, now not looking like such an outlier in the UK. Do you think the UK can rehabilitate itself as an investment destination based on that kind of theme? Is that one to watch?
Yes, we're underweight domestic UK. We definitely are in the camp of sticky inflation higher for longer. Brexit has some structural consequences, which I believe were masked and covered up by the COVID recession. I think there would have been a UK recession at that time post-Brexit, and we have those challenges still. We love the UK exporters. We think sterling's going to be weak, inflation high, and it's a very defensive market, actually. So to risk assets right now, we think Japan's very, very idiosyncratic. It's an inflation hedge, positive for inflation. And the UK has one of the lowest beta markets, the FTSE 100, because it's a very defensive type market. So it's cheap, defensive, but we would be overweight the exporters, but underweight the domestic companies in the UK.
Very briefly, your reaction in a few words to the reversal around some of these green pledges from Sunak.
I don't really have too many comments on that right now.
As an investor, though,
yes. Does it make the UK less investable, that policy uncertainty?
Oh, I see. I think there's a lot of political uncertainty everywhere, and what we have to look at as investors is what's priced into the stocks.
Okay, thanks very much, Dale. Thanks for joining us, Dale Winner, lead portfolio manager at Allspring Global Investments. We appreciate his time. Coming up on the programme, to Tom's point, we'll get back to that story. UK Prime Minister Rishi Sunak has diluted parts of the government's green agenda. We discussed the impact of the changes next. This is Big Back.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
What we begin today is bigger than any single policy or issue. We are going to change the way our politics works. We are going to make different decisions. We won't take the easy way out. There will be resistance, but we will meet it. Because I am determined to change our country and build a better future for our children.
UK Prime Minister Rishi Sunak has softened key parts of his government's green agenda. For more, let's bring in Bloomberg's UK government reporter Joe Mays. Take us through the details, softening on cars, a little bit more on the cost of boiler replacements. What are the key takeaways a few hours after the key address?
Yes, the big policy was delaying a ban on the sale of new petrol and diesel cars from 2030 to 2035. And as you say, some more money for the installation of heat pumps. But, really, this is quite a political move by Rishi Sunak. He sees himself 20 points behind the opposition Labour Party in the polls, and he's looking for a way to shift the tide, get some momentum back into his party. And he's picking climate as an issue where he sees like he can get some advantage. The Conservative Party won that by-election in Uxbridge and South Ruislip in July, where opposition to the expansion of the London ULEZ zone, which is a policy of the London Labour Mayor Sadiq Khan, helped them win that election. And I think Sunak has seen that as an example of where he can gain some electoral advantage. Hence this shift on climate, trying to put pressure on Labour, putting the question to them, would you bring back this 2030 ban? Would you impose higher costs on consumers to reach net zero? So really trying to create that electoral dividing line. It's a risky strategy for Sunak in that many in his party don't like it. High-profile figures such as Alok Sharma, and you've had Lord Goldsmith, Chris Skidmore, because it goes against that green agenda which the Tories have tried to adopt. And also you have elements of the public disappointed, environmental activists disappointed. So, it's a bit of a gamble for Sunak.
Okay, Joe Mays, with the important focus there on the politics of this decision by the UK Prime Minister. Don't worry, though, you won't have to shuffle your recycling into 7 different containers. The world is burning, but you don't have to do that. Coming up, to hike or to hold, the Bank of England faces a tough balancing act, of course, with its rate decision later today. We discuss what to expect. That is next. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lyons.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Markets Today. We're 30 minutes into the European trading day. Here are your top stories. A hawkish skip, bond yields and the dollar climb as Jay Powell signals rates must remain higher for longer. European stocks and US futures are down.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The BOE is next with softer than expected inflation raising questions over whether the UK will get a 15th consecutive hike today. We will also break imminently the Swedish and Swiss rate decisions. Plus, Rishi Sunak rolls back Downing Street's green commitments, including delaying a ban on petrol cars. But the Prime Minister says he won't abandon the UK's climate pledges. So the Bank of England's still on the table for us later today, Tom, but we've just heard, I think, from the SNB.
A surprise coming through from the Swiss National Bank then. They are keeping rates on hold at 1.75%. The expectation from economists had been they go for another 25 basis points, pushing the rate up to 2%. They have not done that. They've kept the rate on hold at 1.75%. A couple of other lines crossing then. They see currently 2023 GDP at about 1%. They can see inflation for the year at 2.2%. And they expect that rate to remain in terms of inflation through 2024 as well, before dipping to 1.9% in 2025. The SNB, though, the National Bank of Switzerland, saying they cannot exclude more rate hikes in the foreseeable future. So is this a hawkish pause coming through from the SNB? I'm checking Euro Swissy right now in terms of the moves there, and there is a big pop coming through for Euro on the back of this. The Swissy is weakening by 0.6% on the back of this surprise. Again, they are holding at 1.75%. The SNB saying that they see inflation just within the range of price stability at the horizon. They are prepared to intervene potentially in the currency markets if needed. And later today, we're going to get more from the SNB, the chairman, Thomas Jordan. That's going to be a really interesting interview on the back of this surprise. And again, weaker Swissy by 0.6%. They are holding by 1.75%. That is the current rate. The expectation is, or was, that they'd go another 25 basis points. They've held pat.
So something unexpected then coming through from the SNB. Let's get to the Riksbank. We're hearing from Sweden and their central bank. Something more expected there. So in line with expectations, Sweden's Riksbank raising its policy rate to 4%. That had been widely expected. The focus has been on inflation and on the weakness of the Swedish krona. Interesting, though, with the emphasis on the weakness of the Swedish economy, that you reach some interesting conclusions about where this takes us. And maybe that's what the market is thinking. The Riksbank also saying the forecast indicates that rates could be raised further, and you might think that that would be supportive for the currency, but none of that has been. So we've seen that as a result of this, we have seen the some deterioration in the Swedish krona against the euro. I'm looking at it here, and of course a lot of people focused on whether we get to 12 on that, because this has been a near historic low for the Swedish currency versus the euro. Not all that far from 12 right now. 11.93 is where we trade. So these decisions not supporting the currency, it would seem, this morning. The Riksbank reducing the currency risk in its foreign exchange. The Riksbank also giving us some other announcements around what it's doing today. But just to reiterate, the Swedish Riksbank raising policy rate to 4%, exactly in line with estimates. And we will be talking to the governor of the Riksbank. That is Erik Thedéen. That conversation will be on Bloomberg. He'll be giving his thoughts later this afternoon. Tom, what do you see on the markets?
European, the benchmark stock 600 currently down 0.6% after a positive day yesterday. The catch up, of course, to the losses that came through on Wall Street. The Nasdaq ended down by about 1.4%. Every, of course, equity index, major equity index in the US ended lower on the back of the commentary, of course, and that decision by the Fed, and primarily the dot plots as well, and the view from those Fed officials that rates will stay elevated through 2024, 5.1%. That big adjustment then in terms of the expectation about the amount of cuts, moderating significantly the amount of cuts they expect to come through by the end of next year. So there is the catch-up play, and yields are also, of course, coming in higher across the European session and the debt markets here as well. We look ahead to the BOE. Where do they land in this debate then? We know it is finally balanced. Fascinating, the SNB, of course, have stand pat. You did, of course, see the ECB coming through with 25 basis points, and then the Fed with their hawkish pause. Where does the BOE land in this debate? That is going to come through, and that answer later today, of course. Across the DAX, you're seeing losses of 106 points, down 0.7%. The FTSE 100 back below 7,700, a drop of 32 points, down 0.4%. Let's flip the screen and have a look at the sectors. Energy's been in focus. Anna was right to flag this, of course, given the run-up in prices that we've seen, all that angst about plus $95 barrel. And oil, and Goldman Sachs has called that you're going to get triple-digit oil within the next 12 months. Well, that has reversed slightly. And again, part of that is down to a bit of profit-taking, arguably, but also, of course, what you're seeing in terms of stronger dollar and higher yields. You're seeing energy as a sector then down 1.2%. Basic resources also taking a hit. 1.5% is the drop there. Tech being pressured by higher yields as a sector off by 1%, catching up to the downside that you saw on the Nasdaq yesterday. One sector remains in the green for us. Retail posting gains of 0.3%. How resilient is the consumer? How resilient is that retail space? For now, there's a little bit of upside coming through, gains of 0.3%. But again, broadly, in a session, we're seeing losses of close to 0.7% across the benchmark. Also worth flagging that autos are taking a hit of 1% after the gains of yesterday, Anna.
Okay, interesting. Lots to digest this morning, from the SNB surprise to the Riksbank doing what you thought it would, but some of its commentary and its decisions not moving the currency in the direction you'd expect. Well, now that's changed, and actually we are seeing that the currency is getting some support from what we've heard from the Riksbank this morning. We'll leave those decisions to the side for one moment. The Fed had its go yesterday. Later today, it'll be the turn of the Bank of England. Will the UK get a hold or a hike? The decision sits really on a knife edge, it seems, following yesterday's softer than expected inflation print, which prompted traders to pair bets on a Bank of England rate hike today. For more, let's get to our UK correspondent, Lizzie Burden, who is outside the Bank of England with a guest. Lizzie.
Anna, thank you. It's a bit chillier than the last time we were here outside the Bank of England, so I'm pleased to say I'm joined by Kitty Usher, Chief Economist of the Institute of Directors. Kitty, thanks very much for being with me.
Nice to be here.
Markets say that this is a knife-edge decision. Should it be a hike or a hold?
We think it should be a hold. So we represent the SME community in Britain, and there was a clear change in the mood with the big hike that took place in June from 4.5 to 5, a drop in confidence, more uncertainty about the future. And since then, we've had a few months of data that just make it really clear that the interest rate rises that have happened so far are doing their job. And we know it takes time for that to feed through. So we think there's quite a heightened risk that the medicine will kind of lead to an overdose if they carry on. And it's probably more prudent to wait, let this sort of cycle of events that have been unleashed settle, and then see whether more action is required.
We mentioned the data on which the bank's made it very clear they're dependent. What about hot wage growth? What are your members telling you about the tightness in the labour market? Is it actually easing?
It is easing a little, though it's still very hard. I think what's become clear to us, talking to our members, and this, tends to be sort of more subtle, maybe qualitative research, is that business leaders want to do the right thing by their staff, and on the whole, they are looking to the CPI figures as they come out to give a sense of what a reasonable sort of cost of living pay increase should be. Now, obviously, in some sectors, it's different where there's collective pay bargaining, and there are particular tightnesses in some areas. But overall, I think it's becoming clear that wage rises are following CPI rather than driving it. And we know that CPI will come down quite substantially in October in particular, because the change in the gas markets means that the off-gen price cap is being ratcheted quite substantially down. So even if sort of nothing changes, it looks like the annual rate will be between 4 and 5 by the end of the year, which is a very, very different situation from where we've been throughout the most of 2023.
Yeah, so treating wage growth as a kind of lagging indicator, as Swati Dhingra said we should. You talk about the kind of lags in monetary policy, that we need to wait for previous hikes to feed through. Are you actually worried about a recession?
Well, I think it's quite notable that in their August forecast, the Bank of England did a projection as to what their GDP expectations were if they kept interest rates as a hold today. And that showed the economy just only very narrowly avoiding recession. So it's therefore common sense that if interest rates rise further than that, then the risks of recession become far, far greater. And that, of course, then unleashes another series of events that, have to work their way through the economy that could potentially mean that the inflation target is undershot. And obviously for all of us, we've been extremely lucky, actually, that we've avoided recession this year. Their previous forecast was completely wrong in that regard. So I think it's still possible to have a soft landing, but we do need to be quite cautious over the next few months.
Just while we're talking about economic growth, of course, we had that announcement from Rishi Sunak yesterday on net zero. What do your members say about that? Of course, many of them will have made investment decisions based on previous plans that have now changed. Could this risk economic growth anyway?
I think the immediate reaction is a sort of slight sort of weariness about the uncertainty that this has created. We represent a broad spectrum of companies, each of which has a different sort of viewpoint on the climate transition. We see some who have it completely embedded into their business model, others who have made substantial sort of changes, partly in response to the transition, partly in response to high energy prices. But most importantly, we also have a cohort who say they're waiting for a steer from government as to what's expected and what's required. And so given that we do need to do this collectively as an economy, the more uncertainty there is, the less likely that investment will happen. And of course, all investment is good for the economy, whether it's driven by a desire to hit net zero or simply to raise productivity and efficiency for its own sake. The two are, intertwined, and so uncertainty just means all of that is less likely to happen.
Kitty, just finally, you talk about the risk of disinflation, of actually undershooting the target, I should say. When do you expect, or when should the Bank of England cut rates?
Well, I think it's very hard to say at this point definitively when or if that will happen. I think the main point for now in September 2023 is that the 14 rate rises we've seen so far, and particularly the one in June, have had the desired effect and have changed the way that people are behaving, causing some, quite difficult situations, particularly in the housing market, that's rippling its way through. And so we need to let that run its course before we can make a judgment about whether there needs to be a further calibration to keep the situation more stable going forward.
We'll have to enjoy the view from the top of Table Mountain for some time. Kitty Ussher, thank you so much for joining me outside the Bank of England. Thank you. That was Kitty Ussher, Chief Economist of the Institute of Directors. Back to you.
Okay, Lizzie Burton, thank you very much indeed. Outside, of course, the BOE with Kitty Ussher, Chief Economist, as you said, at the IOD, the Institute of Directors. Coming up, tensions between Poland and Ukraine are rising, with Poland saying it won't send arms to Kyiv. We discuss that next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on
This is Markets Today. We are 45 minutes into a European trading session that is catching the downdraft from the Wall Street session of yesterday. Wall Street stocks fell on the higher for longer mantra that seems to be coming through from the Fed, and that's passing through into European stocks. US futures then, Tom, also looking a little negative.
Okay, now on to geopolitics and an evolving and apparently increasingly significant situation and theme that's playing out between Poland and Ukraine. Poland says it has stopped supplying weapons to Kyiv, further escalating a dispute over grain shipments that is threatening to break a key alliance in Ukraine's fight against Russia. For the details then, let's bring in Bloomberg's Poland bureau chief, Piotr Skolimowski. I apologize, Piotr. What is causing the rift then between Poland and Ukraine, and how much of this is tied to the politics of Poland?
Hi, Tom. Yes, indeed, it's very much political. Obviously, what we heard from the Prime Minister yesterday was that Poland has stopped supplying weapons to Ukraine, which is a statement of fact, as a matter of fact, because Poland has essentially maxed out of all the Soviet-era made weapons that it has already supplied to Ukraine. It was one of the biggest donors. And they've also indicated in the past that they are not going to supply that military equipment that they are now buying in the US and in South Korea. But obviously, the context of that statement is very important. We're seeing increasing tension between Poland, which started with Poland imposing a unilateral ban on shipments of Ukrainian grain on Friday. And since then, there has been an ongoing war of words between the two countries, especially between the two leaders, which Polish President Andrzej Duda and Ukrainian President Volodymyr Zelensky, who have been very close since the start of this war.
Okay, and give us a little more context as to why this, what seems to be something quite specific and niche around grain, why it matters quite so much, Piotr. I mean, this is turning, as you say, into much more of a public spat, all happening very out in the open, with no doubt Russia listening.
Indeed. The context of the whole situation is obviously politics. Poland has parliamentary election happening on October 15th, so very close. The ruling party is behind in the polls. They are still ahead, but they will probably not be able to form majority after the next election. Farmers are an important constituency for them, and they are being undercut also by the far-right party, which has been taking out some of the votes, and they are benefiting from some of the rising anti-Ukrainian sentiment. So obviously what the government is doing in a way it turned its rhetoric slightly against Ukraine is obviously, first of all, to placate the farmers, who are an important voters for them, but also to take away some of the votes and weaken the far-right party, and in this way somehow eke out gains so that they can actually win the election and run this country for the third term.
What might the, I mean, we're talking about the consequences, Piotr, and it's broad-based, isn't it? So we continue to keep across this. Thank you for the latest, the context and the details, of course, in terms of the evolving relationship and the increasing friction then between Warsaw and Kyiv and the consequences longer term for this relationship and, of course, the war in Ukraine.
Okay, Piotr, thank you very much. Bloomberg's Poland Bureau Chief Piotr Skolimowski. Coming up on the programme, the Swiss National Bank surprises by pausing its rate hikes. We will get more on the SNB and look ahead to the Bank of England decision next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Tourism has really grown exponentially in Iceland in the last decade. And that obviously is not just creating effects on the climate, it's also because most of our guests who are coming to us are visiting the unspoiled nature, and obviously it creates a pressure.
That was Iceland's Prime Minister speaking with Bloomberg's Sherian at the United Nations gathering that we're seeing stateside this week. Let's talk about what's happening in the markets, though. Eddie van der Veld joins us from our Markets Live team and can give us some context on all of the busy news flow that we're seeing this morning. I'm going to start with the Riksbank, Eddie, because that was the one that I was following quite closely 22 minutes ago. Yeah. And it seemed as if one of the issues they're facing, well, they've got a struggling economy. The housing market has been, like Tom said earlier, a poster child, a canary in the coal mine, perhaps, for what can happen to housing markets and property markets when rates go higher. But they've also had inflation issues, and they've also been struggling with a weaker currency. And it seemed as if things had got worse this morning because the currency initially weakened, but then it retraced those losses as a result of some of what they're doing on the FX side of things, selling dollars and euros, buying Swissy. So what did you make of this this mixture?
Look, there was so much to digest in that very brief period where we had a cluster of central banks all the way from Indonesia
the Philippines, Riksbank, and Sweden, and then the S&B, and we had a lot to get through. But as you say, the Riksbank's definitely one of the more interesting ones, and we're seeing the currency up. And I think what you're highlighting is exactly right. They've got a very difficult needle to thread here, right? An economy that's slightly weakening at the same time as inflation staying strong. They're erring on the side of being a little bit hawkish here. They're hiking. They're talking about more hikes, right? And they're also saying that they're going to hedge their part of their FX reserves. And all of those things the market's taking away as, they are continuing to take the fight to inflation. Now, I think we're we're starting to see a split in how central banks react to this. Because on the other hand, you had the Swiss central bank, of course, with delivering a surprise hold going the other way. And we're seeing their currency move in the opposite direction.
And that leads me on to my next question, to what extent do we have to put these central banks now in separate baskets? They have their own idiosyncratic challenges. The Swiss National Bank, and over in Switzerland, they've got pretty much down to their target around inflation, which is remarkable on one level. They have, of course, their own economic dynamics at play there. But you're right, look, the Swissy is falling, 0.6%. They went for that pause, and that was a surprise, holding at 1.75%. How are you thinking about how we categorize these different central banks, the fact that maybe we can't be looking at them all collectively with one single lens?
Yeah, it's a wonderful world in which but the traders will have to actually start trading the macro again, because, in a less forward-guided world and in a more data-dependent world, I think that you are going to see discrepancies, and different countries at different places, certainly from the perspective of their central banks, about where they are. So you are going to see these policy divergences. That makes for volatile trading, but it also makes, for interesting stories. And you could see that, I think this is an opportunity for good portfolio managers to start earning their money again.
Okay, it might be. And we focus on the Bank of England. And to your point, Tom, this is interesting, isn't it? Because you could argue all these central banks are sort of near the top. I mean, I guess that's what might unite many of them in the developed world. But then there are, as you say, big differences. We've had a 2-week period where we saw the ECB continue hiking and the Fed pausing, and then you wonder which way the Bank of England turns because of the inflation data yesterday, and I wonder which of those two is most influential on their thinking.
Yeah, the Bank of England's a very interesting one. I mean, it's a difficult situation. I think most people are now accepting that there is probably a level of stagflation setting in the UK. At the same time, you are seeing CPI coming down. You're probably seeing it come down pretty fast because there's a lot of base effects that are going to come through. So just how long does the Bank of England say that, look, we're going to continue doing this? And then, if you see some normalization, what is normalization in this world anymore anyway? But if you see some normalization at the Bank of Japan, that will throw a spanner in the currency works again. But I do think that the currency realm is where this plays out much more so than anywhere else at the moment.
Brief thoughts. We'll look ahead at the BOJ, but brief thoughts as well on energy, the turnaround. Do you think it's sustained, the turnaround that we're seeing, $92 a barrel, down 1% in the session?
I have to say, oil caught me wrong-footed this year, and it's the one I like to get right, but I didn't this year because I think I expected that OPEC and its partners would start pumping into strength. That they haven't tells us something about where they want to see prices going.
Eddie, thank you so much. Thanks for taking our questions this morning. Eddie van der Veld from the Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie, from Mark, the rest of the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal. Also available, the Markets Today blog. You'll find that under T Live or on the front page of the Bloomberg UK website. That's it for us. This is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. A hawkish skip, stocks falling and bond yields rising as the dollar climbs as the Fed signals rates will stay higher for longer.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
And on a knife's edge, softer than expected inflation raises questions over whether the Bank of England will hike for a 15th consecutive time. The pound weakens for a second day. Plus, coming up on Bloomberg UK, Prime Minister Rishi Sunak faces a backlash after pivoting away from key elements of his government's green agenda, but denies that it's a political move. We'll have all the details and all of the analysis you don't want to miss. Let's kick off the show by taking a look at the European markets because, again, you are seeing red across the screen. This is very, very normal, given that perhaps we're calling this a little bit of a Fed hangover, if you will. Let me walk you through it, though, because you do start to see some real pain really kind of focused into the French index there, down about 0.9%. But take a look at the FTSE 100, actually underperforming, which is interesting because it is still down about 0.4%. But again, the winners of the last couple of days, which, by the way, is on the continent, not here, seem to be the ones that are taking the biggest hit. That is the same dynamic you saw in the U.S. session as well. Your winners of the last few sessions taking the biggest hit, which tells me that technicals, retracements, that is what is playing a role. But again, that's just the equity story. The bond market story also incredibly relevant, especially as we see Treasury curves at cycle highs. And that's really what you need to know about all of these lines, all going into one direction, up. And that is crucial as we talk about just how long the Fed is going to stay at this higher rate level. What's interesting, though, is that cuts have now been priced in for later throughout, not just next year, but the years that follow. And that, at its core, is what the UK now has to think about as well. Inflation, finding a little bit of relief. That's what this white line is all about. So whereas yields are still climbing, inflation is coming down. But the question is how much? The question as well is not just about rate hikes or rate holds. It's about quantitative tightening, those active bond sales at the core of today's decision. Remember, the Bank of England was the first to start tackling the quantitative tightening agenda. Now they're saying, well, look, not only are we going to let them roll off the balance sheet, we're actively going to sell them on the bond market. How disruptive is it? We don't quite know yet. And that, of course, is going to be a question that has repercussions across Europe, which brings me to some breaking headlines that we are getting right now. The Norges Bank raising their benchmark interest rate decision to 4.25%. Now, the estimate was also 4.25%. It looks like they're seeing only one more rate hike, likely in December. Now, here's why this matters, because, of course, already you are seeing strength in the Norwegian krone against the euro. But the other piece of the equation is simply that this is an oil-based economy. Compare this to what you're seeing in the Riksbank as well, where they're really trying to tackle inflation while also monitoring the kind of pain in the real estate sector. The Norges Bank doesn't have that problem. And for that reason, perhaps might be a little bit more bullish towards the Norwegian krone for that reason. That's going to be crucial as we talk about the read-through around the world. To what extent are the oil prices going to be affecting monetary policy? And that's where I want to go when we talk about the Federal Reserve. Bloomberg's Valerie Teitel joins us now. Valerie, there's a lot to talk about with what the Fed really has to revisit, wages, oil, etc. Is the inflation monster gone now?
Well, there has been a lot of good progress, and that's good for the Fed's inflation fight. And I want to say that in yesterday's press conference, one thing we didn't necessarily hear from Powell was a need to see below-trend growth in order to trust this progress on inflation. I think that's a big question for markets now. Now that they have given that substantial upgrade to growth, we saw it in their projections. It didn't necessarily entail that inflation would have a hard time getting back to target. So could we exactly see a cut from the Fed even before this economy turns, if inflation is in fact maintaining this downward trend, is the question that markets are dealing with.
But talk to us about the cuts then, because when you look at the changes in the market pricing here, the idea that cuts are now further out into the, not just this year, but the next few couple of years, tells me that it's perhaps scary, not now, but scary down the road. How worried should we be about a faster deceleration than expected?
Well, look, we're clearly not dealing with that at the moment right now. The U.S. economy is very strong. As we saw in the projections yesterday, they had to upgrade the U.S. Economic growth this year to nearly double what it was previously in June. And Powell seems to be giving this message that as long as the economy is going well, there is no need to cut. We are still seeing progress on inflation. We are still seeing the labor market weaken. So there really isn't any need to move to I guess, a easing bias until we see growth turnaround.
A lot to digest there, of course. Bloomberg's Valerie Teitel all over the Federal Reserve decision, which already you can see having a little bit of a hangover effect. We'll get a little bit more insight. Joining us now, Eddie Vanderwalt. We begged him to stick with us because they just can't get enough of Eddie. Joining us now from our Markets Live team there. Eddie, talk to us a little bit about this market reaction, because when you're looking at the yield space, when you're looking at the currency market, this really does feel like a Fed hangover. What are the markets missing right now?
Yeah, a little bit, but I do think that the market's also starting to move on to the the whole cluster of other central banks that we have. It's starting to get exciting, and it is definitely an FX day, right? I think it's definitely going to be all about how the currency reactions. Well, sure, we'll see some reaction in the short end for the US, but I think that kind of move is now done. What we're looking for is for the Norwegian krone, where they're talking about intervention or hedging of part of their FX reserves, which is really just a little bit of currency intervention by another name. And then the Swiss franc, of course, where they delivered a surprise hold. And I think all of these, if you take it together, what I'm looking at is a market where we're seeing more policy divergence globally, where we're seeing more central banks taking a look at their own economies and saying we've got to act accordingly, and not just take what the Fed does and plug it into our models.
Yeah, the terminal rate gets really interesting here, and I want to bring a quick graphic here because one of the big numbers we're monitoring is going to be not 5.25%, which is what the Fed has increased it to, but 5.5% from 5.2%, but the 2024 rate projections at 5.1%. So you are still seeing this higher for longer narrative that we are watching going into 2024. I think what I'm so confused about here is that when you have these kind of cross-asset fluctuations, currents, whatever you want to do, you're the one who taught me this. The idea that, at the end of the day, in points of crisis, correlations can go to either 1 or to 0, all assets moving at the same time. Right now, the oil market and the bond market are telling you two very different stories about resilience and what resilient looks like in 12 months' time. What market do you pay attention to?
Wow, I clearly taught you too well because I almost don't know how to answer that question, Kriti. Look, we're in a very difficult moment in the world economy, and I think the oil price definitely has a big input into all of that. I think when we look at what the bond market is pricing and what we're looking, what traders are pricing for future cuts in the US, what they're talking about is perhaps an economy that is still seeing inflation, more inflation coming through via the oil market, and that the Fed will be forced into hiking more. Because I think if there's one mistake the Fed will not like to repeat, it's to say that if there is a spike in inflation this time around, it is transitory. I think this time, if they do see oil prices feeding through into the rest of the economy and we see a hot inflation again, they will hike, and they will hike aggressively. And that risks tanking the economy. So you've got this risk of, you know, the plane coming in for a soft landing, it's speeding up, and you getting a no landing, and therefore, you know, pulling back on the throttle and getting a crash. And I think that's what the market is more and more starting to position for.
It's quite a vivid nightmare you just painted us, didn't you? Let's talk about the oil story, though, because at your core, you're a commodities guy.
I am a commodities guy.
Let's talk oil a little bit more, because again, to your point, if you are forecasting this kind of nightmare plane crash, if you will, the first non-recession-proof asset is going to be oil, right? And we just had a guest on Bloomberg Radio say, look, he's actually bullish on European energy for the exact opposite reason, because they're investing in, say, long-term energy. I'm going to bring it back to the commodity story, though, which is how much exposure do you want to commodities right now as a sign of economic resilience, even when it isn't recession-proof?
Yeah, you know, the commodity story is so interesting because I think, you know, it's still very much a play on a comeback in China. Are we going to see a comeback in China? I'm not sure that we are. But, you know, if you're looking towards oil prices, OPEC is clearly signaling that they are willing to keep the prices higher for, you know, higher for longer, if you like, right? They're refusing to pump into the strength that we're seeing in the market. I would have thought they wanted to take market share back if we get close to $100 a barrel. It doesn't seem like they are. Now, you know, guessing what OPEC is going to do in a closed room is a bit like guessing what a central bank is going to do. You can look at the inputs, but you can't, you know, guess at you can only guess at the ultimate decision. And I think that is the problem now, that and because it is such a big input into the world economy and into other people's models, it kind of throws everything else into disarray.
But that's what I mean, you hit the nail on the head, this idea that you kind of have to predict what the Saudis and their counterparts are going to be thinking, which, to your point, is kind of impossible to do to some extent, which again brings me back to, do you foresee some sort of pullback in the actual investment interest? Do you see open interest collapse to eliminate exposure to that?
Yeah, so if you can't predict it, you can't trade it, right?
Yeah.
If you don't know how to price it, if there's no modeling, and more, it is not even OPEC and Russia, it's more and more just the Saudis, right? Who's carrying the market alone. And at some point, they could just turn around and say, hang on a second, we don't want to do that anymore. We're quite happy with the prices that we're getting right now, so maybe we do pump into strength. But one thing about the oil market is we're not seeing that massive recovery in US shale. So I think OPEC probably feels a little bit more comfortable in what it is doing because it's not giving away too much market share to the rest of the world. Because, you know, so I think there is a risk that they test the market, see how far they can go. But like I said, that's a black box, right? It's really hard to predict.
The days of buying a bunch of commodities, throwing them in a basket, and knowing it's a sure thing are certainly over. Bloomberg's Eddie Vanderwalt, we thank you as always. Now, coming up on the program, it's a cliffhanger. We turn our attention to what to expect from the Bank of England rate decision today. That conversation next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap.
as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, Surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lacqua. Joining us now for a look ahead to the Bank of England rate decision coming up at midday UK time. Bloomberg's UK correspondent Lizzie Burden standing outside the Bank of England. Lizzie, let's start off with how yesterday's inflation print changes the picture.
Well, Kriti, there are some who would argue that the last time the Bank of England surprised everyone was back in June with a 50 basis point hike, and that came after some inflation data that surprised to the upside. Well, yesterday we got a surprise, a pleasant surprise at the headline level, the core level, and the services level. So maybe we should expect a hold today, but that would be to suggest that the Bank of England merely reacts to whatever happened yesterday. Well, that's what Nomura and Goldman Sachs reckon will happen. They changed their call off the back of that CPI print yesterday, and indeed the markets pared back their bets on the risk of a quarter-point hike today. Before the print, they thought it was going to be about 90%. Now we're on the knife edge, 50-50. But the thorn in the Bank of England's side is really going to be that hot wage growth that we've seen in the UK. I was just speaking to Kitty Usher from the Institute of Directors. She says not to mind that so much because it's a lagging indicator. So echoing the argument of the Dove on the Monetary Policy Committee, Swati Dhingra. But it'd be interesting to see whether the guidance that accompanies the decision reflects that, whether there's more of an emphasis on forward-looking indicators like the PMIs. But in any case, markets reckon they fully price another hike from the Bank of England. Whether it's today or whether it comes in the future will be interesting to see in the commentary.
Well, you mentioned that markets are actually pricing stuff in already, even though on the surface it does look like a coin toss decision. What is the fallout in the pound and for the gilts?
Well, after the inflation data yesterday, you've seen the pound sinking, and at the last time I looked, Kriti, it was at $1.23. Nomura actually says that it could go to $1.18 if you get a hold and if you get dovish comms as well. Look, the pound has had a great start to the year in the sense that it's been boosted by the higher rates narrative, but in the second half of the year, weak growth really has weighed on sterling. This is a difficult turning point for the Bank of England, whether the pause comes now or later. And therefore, we're likely to see volatility. Volatility also in gilts, because, of course, we are expecting an announcement on QT, quantitative tightening, as well. The groundwork's been laid for this. The Deputy Governor, Dave Ramsden's told us it's coming. He wants to restock the arsenal in case of another crisis. And the expectation is that this pace of asset sales, currently £80 billion a year, is going to be ramped up to about £90 billion, £100 billion a year. If it's more than that, you could see some upset in the gilt market.
From outside of the Bank of England, Bloomberg UK correspondent Lizzie Burden talking to us all things BOE. We thank you as always. Let's bring in Anna Andrade of Bloomberg Economics for a little bit more analysis on that topic. Anna, I want to start where Lizzie left off on these active sales in the bond market. QT at its core, what is the number that spooks the market?
Hi, good morning. So I think anything above 100 billion, as Lizzie said, will spook the market. And already, I mean, the Bank of England has been very clear that it wants QT to run kind of in a smoothly in the background, in a predictable manner, and so that it doesn't have like a lot of impact in tightening financial conditions. But we've heard from Andrew Bailey, I think a year ago, and we've heard from Ben Broadbent as well, not too long ago, that anything above 100 billion, might create some, market disturbances. So I think there's definitely room for increase. The 80 billion, our view is that they will increase to 90 billion, the QT target, and that will be mostly driven by higher redemptions falling over the next year rather than a pickup in active sales. But anything beyond that kind of, it runs the risks of transmitting a signal that the BOE really doesn't want to.
What is the logic there, though? And forgive me, I'm American. This is how we do things. When you look at asset prices and the idea that perhaps the Federal Reserve or any central bank can really pull kind of the rug from under asset prices broadly, for a while that was considered a positive for the Federal Reserve. Jay Powell wanted to do that, to really tackle asset price inflation. So why would the BOE want this to be a smooth process? Isn't disruption into a bond market and an equity market really hitting the heart of inflation a bit harder?
I would say that, QT, the dynamics around QT are very different to the dynamics around QE. So for a long time, we had quantitative easing, so asset purchases kind of acting as the marginal tool. Interest rates hit the lower bound. So, QE was really kind of doing the work in terms of signaling like the commoditative stance. And it's now known that QE was more effective when it was there were some surprise announcements and when it acted at times of high market, disturbance. But and QE at the time really eased financial conditions a lot. But the Bank of England doesn't want the symmetrical effect to happen with QT because it now has room in the with the interest rate to really kind of steer markets and to transmit a signal of monetary policy with the interest rate and doesn't want QT to kind of get in the way of that.
So what could get in the way of this? Because, I mean, there seems to be, the fact that we're even talking about a coin toss decision for the BOE seems surprising to me when it feels like of all the central banks in the world, it's still the Bank of England that has the most work to do. What is the case for a hold?
So, I mean, the case for a hold, and I think, yesterday's CPI print was, crucial for that. It really increased the uncertainty going into this meeting. The case for a hold is that the BOE is monitoring 3 indicators: activity, wage, and inflation. And with yesterday's print, 2 of those indicators have come below its forecast. And its reaction function has always been that any upside surprises would lead to further tightening. But now you have activity kind of coming below its forecast and also inflation coming below its forecast. So the case is like, okay, 2 out of 3 indicators, are below its forecast, so there's reasons to hold. I think, as you said, it's a coin toss. It's really hard to know. The BOE has surprised us in the past. I ultimately think we stick to our call of a 25 basis points today because I ultimately think that, the reality of the data and the experience of the past 6 months is really going to push the BOE into a hike. It's just that, wage growth is too high. The level of inflation is too high. So we have inflation at 7%. When the ECB or the Fed kind of hinted at a pause or, the ECB kind of gave, a dovish hype yesterday, inflation there was at 5%. 7% inflation is still too high, and the risk to inflation expectations is high in the UK.
A really interesting idea that the idea of a hold almost puts a lot of faith in that a lag is actually going to have a bigger effect. Anna Andrade of Bloomberg Economics, we thank you as always for your analysis. Coming up on the program, we stick with the UK. Perhaps a little bit more fun news. Tottenham Hotspur's chairman says he's open to selling a stake in the London Football Club. We'll bring you our exclusive interview with Daniel Levy next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Tottenham Hotspur chairman Daniel Levy speaking exclusively to Bloomberg's Jonathan Farrar. I want to very quickly bring you a headline here. The yen's real effective exchange rate falling to the lowest in 53 years. You're looking at dollar-yen right now. 148.16 is what we'll call it. Of course, we know the BOJ will be coming tomorrow. Yen very much on the agenda. We'll, of course, give you more context in the hours ahead. For now, more context on the UK coming up.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical
critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Good morning and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, economy, financial services, and markets. I'm Kriti Gupta in London. Now, Rishi Sunak is facing a backlash among some Conservative MPs after the British Prime Minister confirmed he is indeed rolling back parts of his government's green agenda, including delaying a ban on new petrol and diesel cars by 5 years to 2035. Now, some see the move as a gamble that ceding ground to green policy skeptics on the right of the Conservative Party will appeal to Britons hit by a cost of living crisis. But Sunak denies is that it is a political move, saying instead that the fossil fuel car ban delay brings the UK into line with nations including Germany, France, Australia, and Canada.
Now, I'm not saying there will be no hard choices, and nor am I abandoning any of our targets and commitments. I am unequivocal that we will meet our international agreements, including the critical promises in Paris and Glasgow to limit global warming to 1.5 degrees.
The opposition Labour Party has committed itself to keeping the original 2030 ban on petrol and diesel cars, so the move creates a clear divide between the two parties ahead of the next general election. And according to a Bloomberg MLive survey, a majority of finance professionals think that a Labour victory would be the best result for stocks and the pound. Alex Morgan reports.
Labour winning the next general election would be the best result for stocks and the pound. That's according to a new Bloomberg survey. About 2/3 of finance professionals said a win for Keir Starmer's centre-left party or a Labour-led coalition could be the most market-friendly option. Now that's going to sting for the current Prime Minister and former investment banker Rishi Sunak, and for his Conservative Party, which has long presented itself as the natural partner for business. It's a sign of the damage done to the Conservatives' economic credentials following Brexit and Liz Truss's disastrous mini-budget. Last autumn, Britain's borrowing costs spiralled after the newly appointed Prime Minister vowed to slash taxes with no details on how she would balance the books. While the ensuing market turmoil forced Truss out of Downing Street in a record 49 days, UK stocks have still not recovered the confidence lost during that period. That's according to 80% of survey respondents who self-identified as portfolio managers, traders, or retail investors. With Labour around 20 points ahead in the polls, they're seeking to capitalise on the government's woes, launching a charm offensive. Keir Starmer and his shadow chancellor Rachel Reeves have made it their mission to schmooze the city and to project an image of economic competence. And so after over 13 years in power, this survey makes it clear that the Conservatives face an uphill battle to regain lost trust and to rebuild their economic credibility. That's ahead of a general election widely expected to be held next year.
Bloomberg's Alex Morgan reporting there on, say, the hot take going into what the UK financial community really wants out of the political sphere. Let's get a little bit more analysis. Bring in Bloomberg's John Stepek, who reported on the MLive survey we just talked about, as well as our UK political editor, Katie Donaldson. John, I want to start with you here and talk about something that Alex had just mentioned. This is pretty not normal, that the financial community would lean towards the Labour Party. What's the logic here?
I mean, really, it's kind of, the Conservatives have been in power for 13 years, so you get a certain amount of fatigue anyway. And then on top of that, obviously, Brexit happened, which wasn't largely popular with the financial community. And then, of course, a year ago, the gilts market exploded in reaction to kind of Liz Truss's premiership and the mini-budget at that point. So the reality is that the city has lost faith in the Conservatives. And on the other hand, Labour has moved from being a hard left party under Jeremy Corbyn to being essentially rehabilitated pseudo-Blairite party under Keir Starmer. And I think it's fair to say that Starmer has done a good job of kind of moving the perception along with Rachel Reeves, his shadow chancellor. And so basically it's just a matter of confidence and also, yeah, kind of political fatigue. 13 years is a long time to be in power, and there have been an awful lot of changes and chaos over that time.
Kitty, weigh in here. Would you agree with that take? I mean, why now? Why make the switch now? And how long can it really last?
I'd absolutely agree with John. I think businesses see which way the polls are going, 20 points ahead, as you said, and they're sort of following where the power will lie. And we're expecting the election probably in the autumn of next year. And if you're a business, you want stability. And actually, some people accuse Keir Starmer of being boring, but actually, I think for businesses, that's what they want, right? And yesterday's announcement by the Prime Minister about changing tack on environmental policies has brought out business worries about the Conservatives that John rightly ascribes to Brexit, and also the Liz Truss's disastrous mini-budget last year. And actually, people are looking towards Labour and going, well, this guy may look boring, but that's what we want.
Well, you talk about boring, and then Rishi Sunak gives you a complete U-turn on this environmental policy. What is the thought on that? I mean, is it politics at the end of the day?
I know, he's saying it's not politics, and you're like, come on.
Kind of sounds like it.
Yeah, exactly. Come off it.
Yeah.
Yes, of course it's politics, and everything should be seen within the light of the election next year. In fact, when we got back from everyone's summer holidays, Labour were kind of off to a flying start, and they started doing their election politics already. And I think the Tories kind of went, oh, actually, you know, they'd sort of been waiting for the economy to pick up, for inflation to go down, and for success on small boats crossing the channel. And actually now I think they've decided that they need to make some big policy changes. And this is the first probably of many. The other one being HS2, the high-speed rail link between London and the north of England. That looks like it's going to be scaled back too. And of course they're working in the economic environment that they have to. So yeah, it's interesting. It's definitely politics.
I wonder how much of the politics then translates to the markets. And John, this is where I'm going to come right back with you here. In terms of the economy, I mean, all the issues that Kitty just brought up are going to show up in the election campaign. How much volatility does that bring into the fundamentals of the UK going into 2024?
I mean, I'll be honest with you, I don't think that politics is going to matter that much, because whoever gets elected, you know, they're operating within a kind of restrained environment, because our debt to GDP is very high. I mean, it's in line with other nations, but it doesn't give a lot of room for manoeuvre. You know, Labour's had to scale back its own spending plans in order to kind of encourage confidence. So from that point of view, I think the thing that's going to matter more actually is what happens to inflation and interest rates. Obviously, we've got an interest rate decision later on today. The hope is that we're somewhere near the peak, and also the hope is that kind of come 2024, inflation doesn't come roaring back. But it's very much going to depend on that for the markets as far as, you know, the rest of it goes. The one risk, I think, is if a coalition government starts to look likely, because that would introduce something new. I mean, at the end of the day, if the Tories get back in, people have got a rough idea of what will happen. If Labour has a clear victory, they've got a rough idea of what will happen. But if it's all up in the air and there isn't a clear win on either side, then I can see that being a risk. But we'll only really find out about that much closer to the election, which is presumably going to be in November.
Yeah.
So.
All right, so selfishly, I am a new resident of London and the UK broadly, so indulge me here. When are taxes going to come down?
Oh, you picked the wrong time to move. Yeah, no, I mean, I think we'd all like taxes to come down, but I don't see that as being something that anyone will propose before the election. We need to see the economy bouncing back first.
Any hope there, Kitty? Am I going to have a smaller tax bill?
Well, actually, I'd have to disagree with you there, John, because part of the reason that the Tories are scaling back HS2 and possibly other big ticket items this autumn is in the hope that they can cut taxes in the run-up to the election. So there'll be another budget in probably March, And I think Chancellor of the Exchequer, Jeremy Hunt, would very much like, and quite a lot of his Conservative MPs would like to go into an election campaign saying, we're proper Tories, we're the party of low taxes and smaller government.
I feel like it almost requires a little bit of patience, which I don't have, but certainly something we'll keep an eye on. Bloomberg's John Stepek and Kitty Donaldson talking to us about things we really care about, tax cuts. Coming up on the program, we take a look at the state of the tech investment landscape in the United Kingdom. We're joined by Eileen Burbridge, partner at Passion Capital and the UK Treasury's former special envoy for fintech. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
The sooner we can get beyond the kind of, oh my gosh, is it going to be the end of the world kind of thing, which I think has a paralyzing effect on the debate. It doesn't, it just kind of goes, ah.
And when there's bias in the here and now.
And yes, I think there are a lot of here and now issues that we can deal with, whether it's elections, whether it's misinformation, whether it's transparency, whether it's provenance. And I certainly urge lawmakers to kind of, fixate on that.
The big real-world event is this technology revolution, and particularly with generative AI, it's going to change everything. It's going to change the way we live, the way we work. It should change government, by the way government operates, the way public services operate. It's got enormous potential to change the healthcare system for the better. But then there are huge risks, because it's a general-purpose technology. You can use it for bad as well as for good.
Former UK Prime Minister Tony Blair there, as well as former Deputy Prime Minister Nick Clegg, now of Meta, both talking about the rise of artificial intelligence, something that, of course, is worrying policymakers and ex-policymakers around the world alike, which brings me to one of the tech stories that we are watching very, very closely. You are seeing some breaking news at the moment that Google is considering dropping Broadcom as its AI chip supplier. This information coming from the information, the publication that, of course, covers these tech stories. And remember, this is coming up amid a broader move from a lot of these big, tough companies to move away from the likes of Broadcom and Qualcomm. You'll remember that Apple, for example, did the same thing with Qualcomm, saying instead, we're going to build our chips in-house. Now, the good news for Broadcom is that they have built a reputation on diversifying their business. So the hit is not as significant as you saw in Qualcomm, for example, but a hit nonetheless. Broadcom shares down 4.6% in the pre-market. Alphabet shares down almost 1% as well. Now, joining us now to stick with the theme of tech, and specifically tech investment, is Eileen Burbridge, partner at Passion Capital and the former special envoy for fintech for the UK Treasury. Now, there is so much I want to ask you, but let's start with, I think, the story that is capturing a lot of hearts and minds and perhaps patience of a lot of people around the world, which is, of course, Rishi Sunak's kind of U-turn on his green policy. Some people would say it's politics. Some people would say it's economics. Where do you stand on that?
Yeah, so far be it from me to cast a personal view, but I think it's clear that he's trying to prepare for a general election, and he says that he's trying to soften the transition, right? Personally, I think that that's a bit difficult because he also says he's committed to the 2050 commitments and those targets. I don't know how we do that if we ease off now. But as an investor, I'm optimistic because I think there's an opportunity now for startups and tech-enabled companies to maybe fill in the gap. So where Rishi Sunak and the government is taking away the stick sort of impact of driving change, maybe there are tech-enabled companies, startups, I don't know, like Isometric, like Supercritical, like Safi, which are a few, just to name just some early stage ones, that'll provide the carrot to incentivize companies and basically society overall to try and, enact some change.
Well, I think it's interesting that we're talking about enacting change here, and I want to broaden out this conversation before we go into perhaps other areas of interest, because as, again, a brand new Londoner, I want to keep on saying that until I'm blue in the face, I'm curious about the investment landscape in the UK broadly. I mean, it's quite clear, I think, even with the latest IPO arm, of course, that a lot of people are pulling away from the UK, even though London remains the dominant center of Europe. What changes that? Do you think Rishi Sunak can change that?
I think there's a lot that can be done to change it, but I would actually try and sort of correct the record a bit. I'm not sure that people have been pulling back, especially in recent times. I think that Brexit, inevitably, especially from a business and a commercial point of view, had a sort of a pausing effect and gave people pause in terms of expanding in the UK, coming to the UK, starting up in the UK, or what they were going to be doing in the UK. And there was definitely some sort of retreat, especially in financial services and the like. Since then, though, so in the last 5 years, and certainly post-COVID, I do think the UK continues to be one of the top destinations in Europe for people who are considering Europe and companies who are considering Europe. I don't think actually the ARM decision is necessarily new. I think everybody knew it was going to go one way or the other. Yeah. I'm sure the government would have been disappointed that it couldn't have been a boost for the UK. But I guess my point is I'm not sure it looked as much of a ding or a loss as it was a lost opportunity and an opportunity not to show strength.
So where does the fiscal policy then come in handy when attracting the arm that will be armed 10 years down the road, the newbies, the ones that they really want to, especially in the fintech space, kind of grow, foster, and keep here? What kind of foundational things need to be put into place right now?
Yeah, you mentioned sort of financial policy or fiduciary policy or fiscal policy. I think there's a lot even outside of that. So immigration, visas for talent, that is the biggest sort of battle that any company's having at any location or any hub around the world, trying to hire more people in order to fill those really, really talented and skilled roles. You heard Tony Blair, you heard Nick Clegg talking about artificial intelligence. We need to keep a center of excellence here in the UK, and actually the government's saying and doing a lot about that right now. But then there are other things for those entrepreneurs that can be done as well. Entrepreneurs tax relief, corporation tax, in addition to sort of supporting immigration, things such as the enterprise investment scheme to encourage investment in early stage companies, also EMI policy for stock options and incentivizing employees. So there's really a lot that can be done in addition to the rhetoric, which I think the government's already started in trying to say we're an attractive place, but they've got to back that up then with action.
You said the buzzword there, which is tax policy, and we just talked about this from a consumer point of view, living in London, but from a corporate point of view, it matters as well. I think Amazon, and I want to say Alphabet as well, have just recently downsized their presence here, again, because they don't want to pay as many corporate taxes. Is that something that's even open to consideration, making the UK more tax-friendly in a way that, say, 5 years ago, Ireland had?
Yeah. I mean, I think we do want to reduce sort of red tape and the administrative burden and regulatory burden, potentially, if there is any, with respect to taxes. However, I do think it's reasonable to have companies pay tax on income that they make here in this jurisdiction. That is the right thing to do, and that helps all of us as citizens and fellow taxpayers as well.
The regulatory piece is interesting, and for time, I won't ask you about the CMA and the Microsoft Activision deal. I'll spare you, but many, many thoughts. Eileen Burbridge stays with us, partner at Passion Capital. Way more analysis next. You don't want to miss it. This is Bloomberg.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg UK. I'm Kriti Gupta in London. Still with us, Eileen Burbridge, partner at Passion Capital and the former UK Treasury Special Envoy for FinTech. More importantly, a former Dallas resident. May I just give a little shout out to that. Let's start with where in this kind of investment landscape, specifically in the UK, looks good to you.
Yeah, so we are early stage investors at Passion, which I think is really fortunate, and it's a bit of a luxury, right? Because we're investing at the very beginning in the formation stages of businesses. It means that we are probably less valuation sensitive than growth investors and people who are thinking about maybe getting a return within 2 or 3 years' time. Our time horizon is really for long-term value creation, and so whether the market's doing well or the market's doing a little bit less well, we can then get really good value. So sectors we're really excited about obviously include AI, as we heard sort of earlier in the hour, but I'm personally really, really interested in healthcare right now. I think having been a US resident, you know, born and raised, and then now being here in the UK, I really appreciate the differences between the healthcare system in America, the NHS here in the UK, and public healthcare system, but I think that gap is ever narrowing. And unfortunately, as beautiful and wonderful as the NHS is, I fear that we won't be able to rely on it for sort of decades to come.
Yeah.
And I think there's a massive opportunity for private payer sort of models. And so one of the things I have the privilege of doing is also running for TIFA, which is a passion capital portfolio company, so disclosure there. But we do reproductive health benefits. We sell to employers who are looking after the well-being and the health of their employees. And so opportunities like that make a lot of sense to me, and I think come from people really thinking about where are we headed.
Well, sticking with the healthcare space, though, I mean, the NHS is known worldwide for kind of being this very early mover on universal healthcare, but the cracks in it, specifically coming from funding, are concerning. I'm curious about the appetite for private healthcare amid a population that isn't used to paying for healthcare. Is affordability, especially right now, an issue?
100%. That's one of the reasons I'm so proud of what we do at Fertifa, is because what we are banking on, or we're predicated on, is employer-funded healthcare. Now, that still doesn't come close to universal, as you mentioned. It means that we'll still have an accessibility problem here in the UK, but it's going some way towards bridging that gap. And I believe, like I was saying, there's so many other things that we need as well to complement this and to fill in the gap. But I'm convinced that we can't rely on public taxpayer-funded healthcare for all of us in a way that we would all want it. Look at the strikes, unfortunately. Look at the wait lists, unfortunately, and it's tragic and it's really a shame. And I'm hoping that our policymakers will be able to figure it out. But in the meantime, I see a massive opportunity for the well-being of all of us in order for private, payer models, whether that's employers, individuals, or maybe some other schemes.
So in our last minute, though, what is the time horizon on that? Because again, we're talking about affordability. My favorite stat from the IMF and from the World Bank is that it's going to take like 5 years for the UK economy to fully recover. What is your time horizon on flipping those profits? Got about 30 seconds here.
Yeah, so we are long-term. We look at sort of 8 to 12-year time horizons, but obviously the quicker the better, and I think there's a real near-term as well as long-term opportunity in healthcare, like Fertifa and other businesses.
Well, let's see if it pays off. Eileen Burbridge, partner at Passion Capital and the UK's Treasury's former special envoy at FinTech, we thank you as always. Now, later today, the UK Chancellor Jeremy Hunt will be speaking to Bloomberg ahead of the AI Summit in London. It's an interview you do not want to miss, coming up on Balance of Power, coming up at 10:10 p.m. in London, 5:10 p.m. in Eastern Time. And of course, be sure to subscribe to Bloomberg's In the City podcast that I host, that Francine Lacqua hosts alongside David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Those new episodes drop every Thursday, and might I add, are really fun to listen to. Up next, you have the Bloomberg Brief. Danny Berger in London and Manus Cranny in New York. They're going to walk you through the Fed's hangover, the BOE, and I'm sure a slew of other topics you don't want to miss, because at the end of the day, it is Central Bank Palooza, and there is a lot to digest. You're going to want their international expertise. Stick with us. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Well, Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Good morning from our world headquarters in New York. I'm Menace Granny.
And from our studios in London, I'm Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda.
U.S. yields spike, the dollar rallies, and stocks slip as the Fed signals it's likely to keep interest rates higher for longer. Next up, the Bank of England. The pound weakens for a second day as the BOE decides whether to hike for the 15th consecutive time. And central bank decisions aside, the risks loom for the markets. A long UAW strike, a potential government shutdown, all to play for into your risk this morning. A very good day to you, Danny. It looks like we have again got to reflect on what is the scale of this hawkish pause from the Fed. Two-year yields made it to the highest level since 2006 yesterday. And of course, it is that mixed messages from the Fed. They don't anticipate a soft landing as being the base case, but what you have here is two-year yields trading just shy of 2006 highs. We've done the Bloomberg survey this morning. Still nearly 60% say two-year yields have yet to peak. With that in mind, you look at what's happening with the oil market. You've got a monster trade going through for the second, third day in a row in $100 oil calls. 200,000 contracts have traded in oil. We're a little bit softer this morning, again, on this higher for longer narrative from the Fed, and another rate hike penciled, or in theory this year, puts a little bit of damage into the oil market this morning. This was the hottest trade of 2023. Inventories at Cushing are the lowest since 2022. But you're seeing monster $100 call trades go through. That takes us squarely to the pound. Now, the pound is at a 5-month low, 123.05. Last week was an 80% assurity that we're going to get a rate hike today. That's down to a towing cost, and it is all about the sell. Nomura say remain short at around 122. You could break to 118. But I want to take your attention to the bottom of the screen, which is Swiss government bond yields. We had a surprise hold from the SNB. This was the shocker. They remain at 1.75%. There was only 4 analysts out there in the market that presumed that down go the yields at the very short end in Switzerland. The Swiss franc, we'll talk more about that in a moment. So again, another little bit of a shocker from the Swiss.
Yeah, and this is a preview for the BOE of a potential pause there. I really love what Peter Scheer said, that we're looking at a Fed, at least, that is trying to find in the data an excuse to pause. Is that a global inclination? But look, we had the hawkish pause from the Fed, and the risk aversion continued well into the Asia session, certainly not buying anything in China. CSI 300 hitting its lowest for the year. Manis, you've been bringing this up all week. Perhaps we are not yet at peak pessimism. Perhaps the ceiling is even higher if you now, yet again, have to worry about a pickup in rates. European stocks also fall with the rest of the market. Only one sector in the green. Finally, S&P 500 futures, those are down about 1/4%. We're just at around 4,400. Julian Emanuel over at Evercore put it, confusion reigns supreme, Manis. It is the confusion over the Fed statement. Risk asset stocks hate confusion. And Manis, in a very clear sign of that, here's my fun fact of the day. Jay Powell yesterday said, proceed carefully, that phrase 6 times in the presser yesterday.
Yeah, look, I think there are seeds of confusion. I know that we both hunkered in on what Standard Chartered have got to say. But what I would say to you is this. You have this shift in the dots that we talked a lot before we went into the meeting. And by taking those 2 rate cuts off the table for next year and the year after, still the market goes head-to-head with the Fed. The market is still pricing 80 basis points of cuts next year. The Fed is saying 50. That classical kind of marriage, which is breaking up, continues to hit the rocks. The market versus the Fed.
Well, I think it's also a case of the market. How much do you want to read into the dots? If they've downgraded unemployment to 4.1%, apparently we can still get there with unemployment at that figure. They're also looking at core PCE forecasts, which are higher than some expected. It is the confusion of the forecasts and the dots. And on this point, Steve Englander, this is what you were mentioning, Manis, from Standard Chartered, sent out a note overnight saying that we see the Fed as somewhat mystified by the resilience of the economy. Powell repeated that they are guided by incoming data rather than estimates of equilibrium, real interest rates, or any model. Manis, we are in the land of no models right now.
I think we're in the land of deep confusion. They just want pure optionality, don't they, Danny? Hence the reason why they've shifted on the dots for 24 and 25. Danny?
Yeah, optionality, a good thing in this unknown environment. Well, don't take it from us. Listen to the man himself. Here is Fed Chair Jerome Powell signaling that higher for longer rate environment.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
Let's get over to Bloomberg's Valerie Teitel. Valerie, the other shocker in this decision was an upgrade to forecast of growth for this year, 2.1%. Do we need, though, to see a growth slowdown for the Fed to have confidence that the inflation is returning to target?
Danny, that is the big question that markets are grappling with. What exactly do we need to see in order for the Fed to drop this hiking bias, in order for the Fed to drop this threat of an additional hike next year? Is it below trend growth? Because it was only months ago he was adamant that we needed to see below trend growth to get inflation back to target. But he has softened that language recently. Even if we look at the revisions, the steep revisions to the Fed's own growth forecast didn't tempt any other members to push for a hike later this year. We still had 12 out of 19 members vote for a hike for the remainder of the year. That was reflected in that dot plot. The market is giving as well, raising an eyebrow to this forecast. We only price in a 50% chance that the Fed does hike again this year. If the stronger economy doesn't lead them to push the terminal rate higher, what does it lead them to do? Danny, you mentioned it all this morning. It leads them to leave those rates higher for longer, as that dot plot reflected, with those 2024 dots rising by 50 basis points. That's what really caused those 2-year yields to break through cycle highs. It weakened the equity market and strengthened the dollar. Now, to be saying this, the Fed does seem somewhat mystified by the strength of the U.S. economy. Powell mentioned perhaps it's because the neutral rate is higher. Perhaps it means they haven't reached sufficiently restrictive yet, or it means they haven't held these rates high enough for longer. Powell said, we don't know yet. We will be guided by the data, but he's thankful that they were out the gates hiking very far, very fast last year. It's given them a bit more room to breathe and that optionality to proceed carefully as the data comes in.
Well, certainly those words, the magic words, which are proceed carefully. from Powell set the tone. Valerie, thank you very much. Valerie Titel in London HQ. Let's get to Oliver Catterwell, Executive Director for Fixed Income Fund Management at First Abu Dhabi Bank, our guest this morning. Oliver, look, risk has taken a bit of a slap. Those twos have popped to the highest level since 2006. We have this knee-jerk reaction, but yet the Fed, in his speech, in his press conference, Chair Powell did not put a soft landing as the base case. When you look at this hawkish hold, what does it take to deliver real rate hikes into next year? Good morning.
Well, I don't think there's going to be real rate hikes into next year. I mean, they're probably going to sneak one more in before year end. And then obviously now the higher for longer dot plot mantra, as you alluded to, I think the biggest casualties there are risk assets, whether it be high yield in the fixed income universe or stocks. I think, on the other hand, investment grade bonds, you know, if they're going to yield now 5.5%, 6.5% for the next 2-3 years, I think that's great for bondholders because you're getting an equity-like return for a very safe asset class.
What needs to happen then if we continue to have higher for longer when we hit maturity walls, Oliver? What needs to happen to continue to prefer investment grade in that scenario when you have folks who took out financing in 2021 at much lower levels and they hit that wall in the coming years?
But that's my point in preferring investment grade over high yield, because I think it's going to hurt the high yield guys more than it does the investment grade. If you take the Bloomberg US Corporate High Yield Bond Index, the time to maturity is now below 5 years. That's the lowest it's been since that index started in the 1980s. That means that a lot of high yield corporates in the US and around the world, they're scared to roll over debt because they can't do it. They're having to roll over debt at double the rates they were doing it 2 years ago. Instead of 5% rolling over debt, they're rolling over debt close to 10%. So I think the big risk, to your point, is in the high yield space, whereas in the investment grade space, you've got a nice decent cushion now of yield. So even if yields do trend a bit higher from here, the downside is capped. If you take the 10-year, for example, if you buy the 10-year at 4.40 today, and yields go to 5%, then you're actually just going to break even over 12 months because of that high carry.
You say we're entering a golden age for the fixed income outlook. So you're not a bond man at heart, are you? But a golden age is your thesis. With that in mind, how much of concern have you got around supply? Because Chair Powell said he sees yields moving up, not because of inflation, ironically, but probably because of growth. And therein lies the real conundrum. It's growth and supply for him. How concerned are you about supply, that pushes one more pop on the upside in the longer yield?
You mean supply of US Treasuries or supply of investment grade bonds in general?
Supply of Treasuries.
Yeah, I mean, I think the surprise supply issuance over summer did take us a little bit by surprise, even though it was telegraphed. So yields, I think that's one of the reasons why yields reflated higher over summer. But at the same time, I think the long-term drivers of US Treasuries, in particular over the next 12 months, are going to be the traditional forces of growth and inflation. And inflation is probably going to be the one that comes down, so hopefully there's no nasty surprises there. The surprise could be growth, and I think Powell alluded to that in his press conference last night, and the fact that they've penciled in 1.5% growth for next year, which is close to trend growth of 2%, shows that perhaps the biggest risk for treasuries and bonds in general at this point is elevated growth levels.
Okay, well, it's something that we can pick up in terms of the conundrum for the Bank of England in just a moment. Oliver Catterwell stays with the brief. Coming up, the BOE, the rate decision, it's coming in less than 2 hours. We'll discuss that with Oliver Catterwell and catch up with the economist Sarah Hewen at Standard Chartered, right here on Bloomberg. Good morning.
For the first, call it 18 years at Chipotle, This was, you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Krani in New York. So the Fed had its go yesterday, and then later today it's going to be the turn of the Bank of England. So will it hold or will it hike? This market on a nice edge following yesterday's softer than expected inflation print. Bloomberg's UK correspondent Lizzie Burden down the street from here at Threadneedle Street. Lizzie, set it up for us. What are we expecting?
Danny, you're absolutely right. This decision is on a knife edge after yesterday's softer than expected inflation data. Markets really paring back their bets on a quarter-point hike from the Bank of England. Many now seeing a hold. In fact, economists at Goldman Sachs and Nomura changed their call to see a hold today. The softer than expected inflation data was that at every level, headline, core, services. But not only that, we've also seen a weaker than expected UK economy. That data is volatile, though. The Bank of England's going to want to see that this is durable. And the thorn in its side is the hot wage growth that we've also seen in the UK. But at the same time, the dove of the Monetary Policy Committee, Swati Dhingra, has told us that's a lagging indicator. You have to wonder whether others on the committee are also looking at more forward-looking data like the PMIs. But we could get a sign of that in the guidance. Even if it's a hike, will it be the last hike? We will look for commentary on that. You've seen the pound sliding after the inflation data. It was $1.23 the last time I checked. Nomura says it could go as low as $1.18 if you get a hold or dovish commentary today. And the other thing to watch out for, Danny, is the gilt market. We are expecting an announcement on the pace of quantitative tightening. It's been £80 billion a year, likely to increase to $100 billion pounds, I should say, a year. But if it's even more than that, could rock the gilt market.
All right, Lizzie, thank you very much. Lizzie Burden there outside the Bank of England. Oliver Kettlewell of First Abu Dhabi Bank is still with us. Oliver, your call on sterling, 120. We're not too far from that. Would you want to downgrade that? Want to give us a new forecast in front of all of your closest friends who watch Bloomberg TV? Are you going to stick with 120 even if they hold today?
Well, we had that 120 call on when sterling was 130, so it was a lot harder to say 120 when it was 130. So, look, we'll stick to 120 now, and I'll leave it to the economists at Fab to update it later. But the reason why we think it's going lower, and I can even see Nomura's point to go to 118, is just because the rates differential is the only thing that sterling's got going for it at the minute. They might end up with the highest interest rate among developed market central banks, but apart from that, everything else is worse. They've got higher inflation and lower growth than the rest of the world, which we think ultimately pulls down sterling. So Manus can wait a bit longer before he transfers all his dollars and dirhams back to sterling, I think.
I think what we have here is probably Danny Berger looking for a much more expensive lunch. I've got the feeling that it's going to be like Gavroche. No, Gavroche is closing down.
He's got to pay up.
Yeah, you got to pay up and look large in this market, which then takes you to the conundrum, Oliver, which is if you look at the gilt market and you look at the yields that we have there, maybe we are at or near a plateau, as Hugh Pill said, versus where we are in treasuries, maybe incrementally a little bit higher. where would you come down in terms of choice between gilts and treasuries?
Oh, I think definitely treasuries. One of the reasons is because just the bias is it's easier for us as dollar investors or predominantly dollar investors to buy dollar bonds, whether it's US treasuries or emerging market bonds or dollar bonds over there in Europe. But also I think that that the Fed is still more likely to cut earlier than the BOE, even though it's been sort of priced out towards the end of next year. I think that the problem with Bailey, I think he wants to be like Lagarde and Powell and kind of say that they're near the end. But as I said, the inflation problem is the most acute. So I think he really has to talk tough and say that they're potentially going to keep hiking, even if they do one more today.
Where do we stand on the fragility of this gilt market, Oliver? Is this a bond market in the UK with traders who are still willing to test and maybe even punish Andrew Bailey for continued missteps and misspeaks?
Oh, I think they will. I think you're right. I think that's why he's got a very difficult press conference today. But that's why I think, and ultimately they'll do the right thing and they'll hike by 25 basis points, and he'll try and sort of give the optionality language to the fact that they'll keep going just to please the markets, because he really has to, because the problem in the UK is so much more severe than the rest of the world. But look, on the other hand, gilts are not defaulting anytime soon, so I don't think that's an issue. It's just a question of price volatility.
Yeah, there was a little moment when we had Trustonomics where perhaps that was a different conversation.
Yeah.
Yen, dollar yen. Yen's real effective exchange rate falls to the lowest in 53 years. Yes, I was around 53 years ago, but I didn't know what dollar yen was. How much of a spoiler, how much of this weakness in the yen could perhaps shift the narrative at the Bank of Japan tomorrow? To close, Oliver.
Yeah, exactly. I think it will. And if you want a more bullish call from me, I think the Japanese yen gets stronger from here. I mean, it's its weakest level now for, I think since the early 90s or so. And, you couple that with the fact that Japan actually has above target inflation now. So that will force Ueda's hand. He will, end yield curve control and raise rates above negative levels probably at some point before the end of the year. Probably won't do it tomorrow, but I think he's going to do it sooner rather than later.
Yeah, that hand is potentially going to be forced. Oliver, thank you very much. Oliver Kettlewell at First Abu Dhabi Bank. Our guest this morning on the rates market. Coming up, we're going to bring you an exclusive interview with Spurs chairman Dan Levy. He says he's open to selling a stake in the club. More on the story. Who could the bidders be? On Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. The Far East, the Middle East, America. But nothing has been put on our table that we felt has been in the interest of shareholders.
Does that mean it was just insufficient in terms of size? Or it was the wrong kind of people and the wrong kind of contract?
Lots of reasons. For us... as a board, we look at we're only custodians of this club. We want to take this club to another level. I think we've shown progression over the last 20 years. We've made a big investment in our capital projects, in our team. And if someone came along and we felt that it could take us to another level, we'd look at it.
It was Tottenham Hotspur chairman Daniel Levy with a bit of a grilling from our very own Bloomberg's Jonathan Farrell, which was show me the money. What size of money was going to come on the table? You know what is ironic? I think there's a big culture issue with who could buy Tottenham Hotspur. Could it be somebody like Nick Candy, Ken Griffin, who came in and tried to bid for Chelsea? Or would it be Saudi money? Would that fit? Would Saudi money that bought Newcastle and United really fit?
Well, it definitely feels like the Americans and Middle Eastern money is coming for English football. Man, it's the most important thing to me, though, is Levy saying that with the money, they could buy back England captain Harry Kane. I was a Tottenham fan only because they had Harry Kane, because I could shout at the TV in my awful British accent, "You're a wizard, Harry." I'm not going to do the accent because it will get me canceled.
You're a traitor to your own postcode. You are a traitor to West London.
I know.
Yeah, that's a disgrace. But then again, of course, probably you're in favour of Harry Kane. Look, I'll leave you with this thought. I mean, some of the biggest deals have been done by the Saudis, haven't they? But take your mind back to 2008. It was in Abu Dhabi. It was Sheikh Mansour who bid up for Manchester City. And then, of course, you've got Jim Ratcliffe and Al Thani going head-to-head for Manchester United. So there's still a whole host of people that could play into this gig. Danny.
Yeah, all I say is don't discount the Americans. That Miami PE fund just bought Everton. It could happen, Manus.
American money, Middle East money, Asian money. We'll pivot to British money with Sarah Hewen, the head of research at Standard Chartered, as the BOE looms.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. U.S. yields spike, the dollar rallies, and stocks slip as the Fed signals it's likely to keep interest rates higher for longer. Next up, it's the Bank of England. The pound weakens for a second day as the BOE decides to hike on a 15th consecutive time today or not. And central bank decisions aside, other risks loom for the markets. It's a long UAW strike and a potential U.S. government shutdown. Now, all of that combining together, but let's be honest, it's really the Fed, the dots moving higher in what has been a very risk-adverse session, man, as it continued well into Asia. Chinese stocks, they're at their lowest since November of last year. CSI 300 closing down by 0.9%. Stocks Europe, not much better. Last I looked, only one sector was in the green. Everywhere we are selling. It's very rare these days that we get a Fed decision and you keep having the risk off. Usually stocks, because they always go up apparently, find a way to claw back. But Julian Emanuel says that stocks hate confusion, and confusion reigns supreme after that decision. Yeah. So, Manus, you get a picture like this. S&P 500 futures just above 4,400.
Well, there was no confusion in the velocity in the short end of the curve, Danny, because we popped and rocked on the upside. This is the short end. Twos were popping up to the highest level since 2006. It would be good if I could find the right direction in a new studio. I just need a whole sort of set of markers for me. It's reorientation. The highest since 2006, and we've done the Bloomberg survey. Still, they think that the short end of the curve has higher to rock higher. Yes, the Fed has left 25 basis points on the table for this year. They did that hawkish pause. They pulled back to 50 basis points of cuts next year. The market still sees 80 basis points of cuts. There is a disconnect between the two. Oil, over 200,000 contracts per day for the past 3 days have traded through on Brent. Yes, we've come down. Higher rates gives you a little bit of pressure on the oil contract because stocks rocked. We went to this knee-jerk, complete risk-off narrative. But over 200,000 contracts per day have traded through on the Brent contract for the calls on the upside. That leaves you to the pound. We're going into the Bank of England today. And again, Nomura calling a softer pound. You want to be short at 122, down to 118. You've got CBW talking about 120.75. We've just had Oliver Kettlewell again talking about the momentum on this currency. Is it sterling weakness? I would say it's sterling weakness as well as a rejuvenated dollar. And keep an eye on Swiss rates at the bottom of your screen. You're looking at 2-year yields where the SNB left rates on hold. That was a surprise. So they're sticking at 175. They're not going to be pushed around by anybody else. So quite a bit of momentum there. But look at dollar yen, Danny. Red headline On a strength basis, on a weakness basis, excuse me, it's a 53-year low.
Yeah, that BIS reported the real effective exchange rate. Manus, after the BOJ last time tweaked their yield curve control, there was this conversation of what happens when they get a test from the Americans, when something happens from the Fed or from the data where yields march higher. We're getting that test now. JGB 10-year yields, those are also at a 2013 high. And of course, we were just talking with Oliver Kettlewell. Maybe the BOJ is where the surprise comes from this week.
Well, we should caveat, yes, he says that that's potential where there's a surprise. He doesn't think they're going to blow off yield curve control now, but that is going to come incrementally forward in the calendar relative to what everybody else thinks. For now, though, Danny, the momentum is still at the short end in the rates in the US because they have not done. According to the Bloomberg survey, and 10s still have not topped out. They will top out somewhere around 4.5%. Danny.
Well, let's get back to that Fed decision, because there was a little bit of confusion around the soft landing. Jerome Powell, the Fed chair, did say that a soft landing for the U.S. economy is the primary objective for the central bank.
Is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that.
Sarah Hewen was watching, listening, as was Danny, as was I. She is the head of Europe and America's research over at Standard Chartered. Sarah, good to see you this morning. Tell me this. Do you now have any better clarity on what higher for longer is by them taking rate cuts off the table in 24 and in 25, skimming those back? Does that help you understand that they're digging in for higher for longer?
That was a very clear message, not just from what Powell was saying, but obviously from the new dot plot. And also the backdrop, I think, one of a strong-ish economy, an economy that slows to slightly below trend next year, but then recovers back to trend, having performed very well this year. And interestingly, unemployment, which barely budges. So the Fed seems to be saying we are in this Goldilocks scenario where we have a strong economy, low unemployment, and they clearly feel comfortable to an extent that inflation is going to be moving towards target over quite a number of years, I have to add. They don't have inflation down at 2% until 2026. I think that there was quite a large degree of caution in those forecasts because unemployment barely budging does raise the risk that wage earnings growth just doesn't fall in the way that it needs to if inflation is to move to target. So I think that is really behind, that's the backdrop
and Sarah,
to the rates high for longer.
The backdrop is also a Fed, an FOMC, a Jerome Powell that doesn't have control over oil, doesn't have control over labor strikes and wage negotiations, and doesn't have control over Treasury supply. Does that worry you?
Yeah, I mean, Powell addressed each of these, and in terms of labour strikes, he said it depends how long they go on in terms of the impact on the economy, but also what message does it send for wage earnings growth and how sticky wages may be going forward. On oil prices, interestingly, we got back to the transitory commentary again. So oil prices, he says, are volatile and they only become a problem if it's high for a long period of time. Now, we think that oil prices are moving up, that we think that they're on an upward trajectory, and we don't expect that they are going to drop back again. So that becomes both a headwind for growth, but also potentially a driver for inflation expectations, which could be challenging for the Fed.
And on those inflation expectations, Sarah, I mean, I did the market check. I talked about oil, 200,000 contracts per day have traded through the oil market. Again, trying to set up for $100 oil. Now, gasoline prices have risen in this country. Rents, I can tell everybody officially, the rents have not peaked in this country, in this city. But, you know, you have those two big drivers in this economy, which is rent, owners' rent, and you also have oil prices and gasoline prices as well rising. Do you think that the inflation situation is anchored or at risk? I mean, I know the trend is lower. We've turned over, we've turned down. But talk to me about your view on whether we're in a more anchored inflation narrative here and continuing to decline, or do you think we're going to hit a wall?
I think we are anchored, and our view on the economy is a little bit more downbeat than the Fed's, and that's based particularly given the new Fed forecasts when, if they do indeed hold rates steady, then essentially we're looking at another 100, 125 basis points of tightening in real rates over the course of the next year. And we're already seeing some signs of distress. The economy has been doing well, but there are special factors behind this current quarter's strength. Credit growth is slowing, delinquencies are low, but they're rising. The job story is declining, and we think that the headwinds to the economy are rising. So that would suggest that inflation trends should move lower. I'm not so concerned about the energy costs or indeed the sort of shelter rent costs, because I think ultimately new rentals suggest that rents will come down. So it does get back to this core services question, and there wage growth is key. If wages do continue to nudge down, and they should do if the labour market softens, then inflation will also fall.
Manus, you know what's really fascinating? Sarah, they're talking about wages falling in the U.S. Here in the UK, we still have very stubborn wage inflation. But does that CPI figure from yesterday shake something up? Manus, you and I covered it extensively. It moved the entire bond market.
Yeah, but this is where, Sarah, and you know, Seema Shah said yesterday to us, warned us yesterday, that we shouldn't be fooled. We had this knee-jerk reaction on the back of the CPI. That's the point that Seema made yesterday, Danny, isn't it?
Yeah, no, it's exactly that it's one piece of data. It doesn't make a trend. Sarah, for you, how much do you want to read into that cooler than expected CPI? Does it allow Andrew Bailey to put rates on hold?
They'll certainly be considering a hold decision today, but we think that it's a knife-edge choice. We think that on balance they will raise rates again, but very prepared to be proven wrong in a couple of hours' time. The wage behaviour, the labour market does seem to be softening. Wages have been really sticky. They're very high, and of course we're coming down on inflation, but from a very elevated position. We're way higher than inflation in the US and in the euro area. So arguably there is still more that needs to be done. And we're not particularly getting clear signs that the economy is about to hit the wall.
Okay.
So overall, I think another rate hike is possible.
Well, there's another brick in the wall. Excuse the pun. We're trying to look for the number ones and number twos here. But cable is at trade at 123. It's just broken 123. Oftentimes people go, central banks don't look at currencies. Well, the Bank of Japan does, and the ECB, even if they don't admit it, they do. Here we are. Sterling is under pressure. That's a construct of dollar strength. But what are the ramifications of this weaker sterling? We've got Nomura calling it down to 118 on cable, and other calls for lower sterling. Just talk us through what that means from a macroeconomics perspective for you.
It's bad for inflation, and it will be a concern to the Bank of England. I'm not sure that whichever decision they take today is going to help. If they stay on hold, then that will be seen as dovish. If they hike, then markets may feel that they've just gone a step too far and that ultimately they'll have to cut rates more. So cable is under pressure, particularly given the hawkish hold from the Fed yesterday. And the markets do worry about the fundamental risks to the UK economy, even though we're still growing. I think the concern is that a recession risks are probably highest in the UK of all the major economies.
All right, Sarah, well, we got an hour 20 minutes to go until the BOE decision. We'll let you go get some lunch beforehand. We all got to refuel for what is a very close call. Sarah, thanks so much. Sarah Hewen of Standard Chartered. Now, coming up, the UAW's chief negotiator says Stellantis' new offer doesn't look good, suggesting the union will keep digging in its heels. We got that for you next. This is Bloomberg.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
For us, the Palestinian issue is very important. We need to solve that part, and we have good negotiations continue till now. We gotta see where it will go. We hope that it will reach a place that it will ease the life of the Palestinians and get Israel back, as a player in the Middle East. Every day we get closer. It seems it's for the first time a real one, serious. We gotta see how it goes.
That was the Crown Prince of Saudi Arabia, Mohammed bin Salman, telling Fox News yesterday that the kingdom is getting closer to normalizing diplomatic relations with Israel. What are the roadblocks they're in? Most likely over Palestine. Anwar Gargash here from the UAE yesterday talking about the very same topic. Let's talk about some of the other stories we're tracking from around the world, setting the agenda for you today. Ukraine's president met yesterday with Wall Street leaders, including Ken Griffin, Bill Ackman, to discuss using private sector funds to help rebuild the country. Now, the meeting comes as Russia hits Ukraine with its heaviest barrage this month.
Now, Manis, over in D.C., we're all on shutdown watch yet again, and House Speaker Kevin McCarthy won the support of a few of his party's hardliners last night. It's an effort he has right now to pass a short-term spending bill, but the risk of a U.S. government shutdown remains high, Manis. It's just 10 days before a funding collapse.
Meanwhile, the UAW enters its 7th day, Danny, of strikes. No signs of resolution with the big three automakers. Now, the strikes, they will expand tomorrow. They're set to expand tomorrow. Negotiators don't prove fruitful. He's tracking every twist and turn in this story. Oliver Crook is with us. So my reading is there's another new offer on the table, but one of the big three automakers are not biting. Oliver, good morning.
Good morning, Menace. That's right. We're about a week into this now, and we've got the 5th offer from Stellantis on the table to the negotiators. Still some distance apart. We heard from the negotiators saying it did not look good for us. But what's interesting is what he went on to say is the holdup is product. They didn't want to line up products for our plants in the future. So as much as this is a strike about wages, a living wage for an auto worker in the United States in 2023, this is also about the intense anxiety about the future of this profession and this industry. The EVs, for example, which require a lot less assembly and a lot less parts. And for the auto companies themselves, they may not want to commit not knowing what the future of this industry looks like.
I mean, it's not too dissimilar. I mean, obviously wildly different, but what's happening in Hollywood, the fears of AI and what that does to writing jobs. So, Oliver, if the car makers themselves, the big three, the Ford, the Stellantis, the GM, if they don't want to commit not knowing the future, how do they respond concretely to this?
Well, so far, you know, Ford and GM also have had no luck as far as it goes with these agreements. Mary Barra yesterday going out reiterating, saying that the costs and the demands are just way too high. We understand that GM's latest offer is worth about $150,000 annually, all in terms of what the compensation is worth. That's not what they'll make. That includes benefits. But what's interesting is now the spillover we're starting to see. GM has idled a plant in Kansas. We understand that affects 2,000 workers. Stellantis idled some workers as well. And there's also spillover in terms of labor. Another part of the UAW, which is not to do with the big three, but works in parts, they've also walked out in Tuscaloosa, Alabama. Who does that affect? They build axles for Mercedes-Benz.
Tuscaloosa, Alabama. Listen, before I ask you what's next, I'm going to ask it. Yeah, let's throw them a curveball. So who's going to go first when it comes to AI? Anchors or reporters? Who's going to bite the dust first, Ollie? Be very careful.
Listen, I don't want to talk my own book because that would be pretty poor reporting, but I have to say that perhaps the reporters who go out into the field and just sort of stand in the rain and all that sort of thing, I don't think you can convince an AI bot to do that.
No. Who taught you to stand in the corner? Who taught Ollie to stand in the corner, a street corner in the rain? Hey? Yeah?
Yeah,
That's
I think
right.
it was
No one does it
Manus.
like
Didn't
Manus.
Manus teach you how to do that? An AI could never teach you how to do that. And that, therein lies the value of Manus. Me, I'm kind of worried. I need to think of why the bots can't replace me. I've now gotten suddenly very worried.
No, definitely not. Don't worry, Oliver. No bot is going to replace you. I just need you to get a social media account and help us all the way. Tracking the story live and in person. Oliver Crook.
Ollie, thank you so much for your help there. All right, that's the latest there with UAW and the future of our job security. Not looking great. Anyway, coming up, a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. All right, let's get you set up for your trading day. Here's what's ahead. We're going to Bank of England rate decision. That comes at 7 a.m. Eastern time with a pause or a hike hanging in the balance. These markets, they are divided on that after the CPI yesterday. Then we're also going to be getting the latest read on U.S. initial jobless claims. That will hit at 8:30 a.m., followed by existing home sales. That one comes in at 10 a.m. Then we're also going to have President Biden welcoming President Zelensky to the White House at 3 p.m. Of course, he was in New York for the UNGA. Manus, we also, after the BOE today, we have the Bank of Japan tomorrow, feeling the pressure of higher yields in the U.S. and a stronger dollar.
Absolutely, and we know that they've got form, they've got history in sort of almost like silent assassin intervention, and then we go, whoop, what happened to dollar yen? It is the real effective exchange rate. We touched on it earlier. It's important. If you're waking up on your way to work in New York, it's dollar yen is actually where the big action is. This is a record low going all the way back. Our data goes back to 1970 at Bloomberg. This is the pressure for the new governor at the Bank of Japan. Danny.
Yeah, and, you know, Janet Yellen even this week gave the green light essentially for the MOF to intervene in their currency. Maybe that's the route they go because, as one hedge fund trader put it to me, Ueda doesn't want to be that guy, Manus. He doesn't want to be that guy that finally breaks growth in Japan.
Here's the other thing. Does unilateral intervention really fundamentally change the direction of a currency, or do you need G2, or do you need G3? Have a look at the crosses. You've got yen weakening overall. Yen, the dollar is down. You've got the euro. You've got a little bit of friskiness in euro yen and in sterling yen. Michael Metcalf says at State Street, yen is still way too cheap. It's becoming more of a hindrance than a help to the rationale to at least stop further yen weakness. That's the key for Michael over there.
Yeah, man, it's probably just worth whipping through what this bond market is doing after those big moves, those cycle highs for the front end that we saw yesterday, not last year, certainly yesterday. Front end comes in just ever so slightly, 2 basis points, still at 515, but man, is still pressure in the long end. Is it about growth? Is it about treasury supply, as Powell himself said?
Well, you know, proceed with caution. That was the message from Fed Chair Powell. We've also done the Bloomberg survey. Everybody should jump on and look at that. Fed Go. What you've got is a lack of belief that the Fed is done. On the short end, yes, they've left 125 basis point hike on the table, but the survey says still higher to go on the short end of the curve and higher to go on the longer end as well. So there's a lack of belief. And the market believes, actually, ironically, there's going to be 80 basis points of a cut next year, not the 50 that the Fed have said. But it's not all macro, is it, Ms. Berger? We have a little bit of micro.
Yeah, we do. Why don't you kick it off with FedEx? What's going on over there, Manus?
Are you sending me a gift? Is that what you're doing? Are you sending me welcome to America? Yeah?
I know New York is expensive, but London's not that much better, Manus. I can't be spending willy-nilly, sending you gifts.
Oh, I expect everything. Look, there you go. We're up just under 5% in the pre-market. What is it? They have basically hiked their estimate for the earnings per share. So it's a nice bullish call for them at the front end. They've raised the lower end of the fiscal 2024 EPS forecast. Basically, it's bullish, and you've got Citi raising their call there to $300. Danny, there you go. Twists and turns. I just need a new roadmap for this big space. It's a big, big space. I'm lost.
I literally thought you were about to say Rolex, and I was going to say, Manus, you got to wait for Christmas for gifts. At least Christmas, and then we'll get there.
business.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
We intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
We're running strong growth. We're running inflation that's above target, so it makes sense to guide towards higher for longer.
There is a concern on the other side of this that they're going to need a higher neutral rate.
The economy has changed since the shutdown restart, and the Federal Reserve is still struggling to come to grips with that.
The Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We are proceeding carefully, not us. This show's a mess. Chairman Powell, apparently, over at the Federal Reserve. Live from the City of London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative yesterday. The follow-through, not positive. Equities down by 0.5% on the S&P. Yields at the front end, cycle highs off the back of that Fed decision. TK, I think we call that a hawkish pause.
There's a hawkish pause on cycle highs back to 2006. I'm going to just state it flat out, John. I think it's underplayed this morning. It is a whole new world after all. The real yield burst through 2%. We're out at 2.07%, and the 10-year real yield, that affects everyone watching and listening. It affects big business. It affects Wall Street. It affects the fabric of the nation.
I thought he was tired in that news conference. I was getting frustrated listening to him, almost emotional, so I wrote down my thoughts. If I was feeling mean, I'd say Powell sounds totally confused by the Fed's own projections. If I was feeling kind, Lisa, I'd say it was just conveying the appropriate amount of uncertainty that underpins any forecast. Are you feeling mean? Are you feeling kind?
I'm feeling Jim Caron, who said that data dependency means they have no clue, basically. They have no idea what is going to happen. They can't predict it. And so they're basically saying, look, we have a number of parameters, and we're going to go with this baseline. The problem is, to your frustration and the mean side, there is a question of what those parameters and balance of risks are at a time where they seem to emphasize inflation, but still seem to be hoping for that soft landing.
We're very lucky. We start strong. We got lucky here with Andrew Sheets scheduled months ago, and he's going to come in and explain this to us. He had textbooks at Brown University with Bill Poole. None of this is in the textbooks on macro that Andrew Sheets studied with a legend from the Federal Reserve Bank of St. Louis.
I hope Andrew is in a position to explain it, because I can't explain it. In the projections, as Lisa was talking about, they're forecasting a soft landing. Then he says it's not the baseline. It's not the baseline, it's the objective, but we're forecasting it anyway. So what are the forecasts?
It doesn't make sense. And basically he said, forecasting's a difficult thing to do, and, you know, it's hard to know, and et cetera. So at a certain point, either saying his forecasts are de facto wrong, or that basically he is not willing to accept the forecasts. I mean, basically, he's saying or he's going to redefine it a new way. It was not coherent.
Let me give you one of the factors here. I was explaining to a young lad in TV. today the collapse of Disney. Okay, Disney's got to go
Were you
out.
really?
They got to jettison ESPN. What are they going to do with Hulu, John, besides you pay your monthly bill?
I think they're going to take the outstanding shares of it.
They're going to take out Comcast
absorb
on that.
the whole thing, sure.
Their financing of all that has a new
I'm financing it for the record.
No, they have a new expense in the last 3 days because this real yield's popping, and it permeates from Disney with Mickey Mouse all across America.
I take your point, and I think it's an excellent one. Basically, it's one thing if rates are high in a short term. If rates are high for a long term, suddenly companies that have avoided paying higher expenses, individuals who have avoided paying higher expenses, have a new reckoning, and suddenly we have to look at a new parameter of potential damage to the financial markets.
End of the year into next year. The regional banks, you look at the Keefe Bruyette Index, it's a train wreck. And I'm sorry, this redounds directly down to the banking system. Our interview of the day is James Dimon. We're expecting Mr. Dimon to move from Detroit to London to talk to us.
Oh, you think that's going to happen? Like a permanent move or a conversation? I think it's a conversation coming a little bit later. Lisa will give you the day ahead in just a moment. Your equity market is negative. We're down by 0.5% on the S&P 500. Yields on a 10-year up another 2 basis points, 4.4313 on a 10-year this morning. In the FX market, more dollar strength, a little bit of euro weakness here, Lisa, 106.53 on euro dollar.
It has been already a central bank bonanza in the past 24 hours. We've already heard from the Swiss National Bank as well as from the Swedish and Norwegian central banks. At 7 a.m. we get the Bank of England rate decision. And what's been happening over the past couple of sessions after yesterday's lower than expected CPI print is people are actually downgrading their expectations for a rate hike. So my focus is going to be on the 2-year UK yield and on the pound, which people say could potentially weaken further from here versus the dollar. Today, U.S. economic data included jobless claims at 8:30 a.m., existing home sales at 10 a.m., and former St. Louis Fed President Jim Bullard will be joining our own Michael McKee on Bloomberg Television at 8 a.m. And today, the Bloomberg's Global Credit Forum will be happening in London. It's why we're here. We're going to be having a Bloomberg surveillance special at 10 a.m. with Jim Zelter, Apollo Asset Management co-president.
Is he in town to buy a soccer team?
You can ask him that yourself.
I've already asked him. He's not.
Okay, so there we go.
I asked him this morning. He's absolutely not in town to buy a soccer
team. It's just basically you can have a cheat sheet there. But to me, the big question is, what is the new landscape for credit if you have higher for longer? How does that change the equation for people who have suddenly thought, wait a second, maybe rates are not going to go back down to where we thought they were even a month ago?
That maturity wall out in 24, 25 starts to look a little bit more worrying. Andrew Sheets with us around the table here in London, Head of Credit Research at Morgan Stanley. Andrew, good to see you. Can you square the circle for us? What are those forecasts about at the Federal Reserve?
So I think that this is a case of strategy and tactics from the Fed. I think the strategy is one where even if you ultimately want to pause rate hikes now and cut rates next year, and that is our forecast at Morgan Stanley, we think the Fed is done, sounding more hawkish now, sounding more serious, sounding more vigilant on inflation is the smart move, especially in a world of uncertain data and very high, uncomfortably high inflation over the last 12 months. So I think the Fed would much rather be in a place where it can be positively surprised, where it can talk somewhat more hawkishly now, but ultimately that will allow it to more easily pivot to somewhat easier policy, which we think is appropriate given we think policy is quite restrictive. On the tactics that would allow that, you have some really interesting data coming at the end of this month. You have a big potential GDP revision at the end of this month. We have core PCE, which we think on a 3-month annualized basis in the U.S. is going to fall to 2.3%. So if we get a bit of a downward revision to GDP like we expect and lower core inflation like we expect, it makes the Fed's job a little easier.
Horse before the cart. Do we get a Zentner, Ellen Zentner marking down her GDP view and revisions? Do we get a lower real GDP because the real yield is moving up into a level we haven't seen since December of 2008?
So I think that's part of it. I mean, again, I think the real core question kind of haunting markets at the moment is, what is the neutral rate? Is policy really restrictive? And I think that's been a very hard thing for central banks to determine, especially because its rates have risen so much more than anybody expected. But we do think policy is restrictive. I think you're seeing a lot of signs of that, from job growth slowing to core inflation moderating to bank loan growth slowing down rapidly. And so, Tom, I think that's all very consistent with this idea that these real yields are restrictive to economic activity.
So if someone were to say to you, what part of the forecasts are wrong, you would say the unemployment rate, that actually it has to be substantially higher and that there's more economic weakness than the Fed is projecting out. Is that correct? Is that what I'm hearing from you?
So we actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to to ultimately relax policy and start cutting rates by March of next year. So it's in core inflation where we differ from the Fed's forecast the most. That's a number we'll know a lot more about potentially at the end of this month.
What do you think is going to be the consequence of a government shutdown, as Jim Bianco said, where you don't get the data? And we don't get the data potentially for a significant part of October, maybe beyond. How does the Fed handle that? How do you as an economist handle that?
That is a great question. And again, a little bit of uncharted territory. So first, we do think that government shutdown will slow economic growth, will be another reason why growth could moderate some into the end of the year. And that's another reason for the Fed to stay on hold. And look, this will put the Fed in a more difficult position. But again, we think it could be still consistent with the idea of staying on hold. We don't have the Fed taking any steps of action until March of 2024 and trying not to do anything radical or significant if we don't think the data supports it or if the data is not available to support it.
There was a great question in the news conference. Shout out Steve Leisman. How many years do we need to be above neutral before we start thinking neutral is just higher? It's a pretty solid question. Did you get a satisfactory response from the chairman?
Well, I don't think we know that as a market, but I think it is fascinating. I think the market is clearly assuming the neutral rate is higher. You look at the 10-year yield at 4.30. That is, I think, very consistent with a higher neutral rate over time. And I do think that is one of the biggest surprises of the last 2 years is we've been in a decade where I think we were sold a story that the neutral rate is incredibly low due to secular stagnation and demographics and a number of factors. I think that's clearly different. So we still think rates are somewhat too high over the long run, but we're clearly operating, I think, in a higher neutral rate regime than we thought before.
I don't think we should allow the Federal Reserve to produce forecasts and then tell us they don't matter. Don't publish them if they don't matter. Do you think they matter? Are they forecasts, real projections, or aspirations? What are they?
Well, I think they are the best estimate of a very smart group of economists, but they are ultimately still uncertain, like any forecast is.
But Andrew, to cut in, their best estimate right now is that unemployment barely needs to rise to get inflation back to 2%. And then the chairman in the news conference totally fails to explain the underlying dynamics and why he's concluded that's the case. He's extrapolating out current conditions this year out to next year and the year after that. Don't you think that warrants a bit more attention? Why aren't we getting a sufficient explanation from the chairman and this Federal Reserve as to why they think we found this new way of doing things, that you can get inflation back to 2% without higher unemployment?
So I guess I also feel I need to justify that because that's very similar to Morgan Stanley's own forecast. And I think part of it is that we also saw inflation spike much more than you would expect given the level of unemployment. And so I think we are still seeing some normalization of factors that were unusual over the last several years. You're seeing some healthy elements in things like shelter inflation that could suggest that, again, even with unemployment relatively constant, kind of spot shelter inflation is coming down quite sharply. And some other elements that, again, are somewhat unrelated to the labor market, Medicare being able to negotiate drug prices, lower healthcare costs. That's a big part of spending. That's a big part of GDP. That could also be a source of some disinflationary pressure outside of unemployment.
Let me go to Bill Poole at Brown University long ago and far away, which is a monetarist view of great belief in M2. And I'm not asking you to do an M2 dissertation. But the bottom line is this cacophony of uncertainty is because of massive fiscal stimulus. What's the tail of, as Olivier Blanchard would say, the Biden stimulus?
So this is, I think, I think we could know one number for certain over the next 12 months for economic forecasting, it would be the fiscal numbers, because they're very important and they're very uncertain. These are hard numbers to forecast. If I look at Morgan Stanley's forecast, yes, we have federal spending slowing, but state and municipal spending stays very strong. And so that's a reason why we don't have a larger drag, even though you see these very high deficit numbers that I think in theory would suggest.
Does that keep nominal GDP up?
It does. It does. So that's a big reason why we see a soft landing next year. That's a big reason why we don't think that fiscal reversal is a driver of recession.
So punchline, why aren't you super constructive on risk assets, given everything you've just told us?
So I think it goes to Tom's point about the real yield, that real rates are higher, and that matters, I think, across asset pricing. So we've had a market where the S&P 500 is appreciated this year entirely through valuation expansion. These higher real rates, I think, create some risk there as earnings aren't growing. At the same time, I think many bond yields, many high-grade bond yields where you're getting kind of an average a high-grade spread and then an attractive real rate, those are good. And I think we have seen over time a pause from the Fed has been very good medium term for a buying opportunity in high-grade bonds.
Andrew, thank you, sir. It's good to see you. Andrew Sheets there of Morgan Stanley on the Federal Reserve. One more decision to come today, the Bank of England. On to tomorrow, the BOJ. plenty of that still to come. Bramo, from your perspective, we didn't get a satisfactory explanation from the chairman. Did you get one just then?
No, except that there's a lot that we don't know, and this time does look different in terms of a soft landing, in terms of the different aspects of the economy that have been moving at different paces, coming together in a sort of jumble of not screaming incredible risk appetite, but at least a steadying of inflation with solid growth. My question with that is, when does a valuation concern become a fundamental concern when some of these businesses have to actually borrow at these rates?
You're thinking high yield?
I'm thinking of high yield, and I'm thinking of cuspy investment grade, the ones that are sort of at the bottom ranks of investment grade. When does that become a serious credit problem that feeds into the economy?
Cuspy.
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 That was jargony.
God's
I apologize.
name is cuspy.
It's a new word.
It's like bond talk?
Is that on the cusp of high yield?
Yes, yeah.
Okay.
Cuspy.
Okay.
Actually, that was jargon.
Triple B's?
Yeah.
I was over in Mayfair last night.
Got it.
The ones that are like
John, I was
minus. Okay, good.
I was
good
in
to know.
Mayfair last night looking at Bentleys, and
Of course you were.
Yeah.
I look at
We
the
live
finance
such different
here.
lives.
On such
levels. I look at the finance.
It's like
You get the
shoveling in a
real
shop
yield.
salad to get to bed, and he's gone to look at
No,
Bentleys.
you weren't.
You look at the real yield where it is, and those kind of transactions become difficult. That's how you get this.
A lot of those
reduced
guys are paying
GDP.
cash for what it's worth.
Not this guy.
Live from London.
I'm worth $9 million.
According to the internet, yeah.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Today, surveillance is live from London for the Bloomberg Global Credit Forum. After a decade of cheap credit, Tom, John, and Lisa address the risks in today's debt markets and the opportunities ahead. Tune in at 10 a.m. Eastern, 3 p.m. London time for the special episode featuring an interview with Apollo's Jim Zelter.
I got my hands full.
Only on Bloomberg. Context changes everything.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Chairman Powell down, Governor Bailey still to come, Governor Ueda coming up tomorrow. The Bank of England decision a little bit later this morning. That decision about 40 minutes away. Guy Johnson's going to break that down for you right over there on the corner at Threadneedle Street. We'll catch up with him a little bit later. Let's get to the price action. Equities rolling over on the S&P 500. Negative here by 0.6%. Softer yesterday. Negative follow through. Yields higher on a 10-year to 442.93, up 2 basis points. This move in the 2-year. Let's just sit on that. At the moment, the 2-year yield is a little bit lower, at 5.15. Bramo, in the last 24 hours, a whisker away from 5.20 on a 2-year.
It is shocking how far we've come and how we're talking now about 5% benchmark Fed rates for the entirety of next year, barring maybe a couple of months at the very end. To me, this is a sea change. And whether we've seen it actually trickle into the rest of the asset sphere, I don't know the answer yet, and I think that's going to be a big question.
The conversation we were having around the table yesterday is whether we've really started to internalize that high for longer message, Tom, based on where that 2-year is currently. I think the answer to that is yes, increasingly we are.
I'm going to run it every 20 minutes here. It's a whole new world after all, and it is. There's been a sea change in the last 48 hours. You see it in the real yield, and again, it's expressed in the 2-year yield, and the idea that this doesn't have ramifications for U.S. 10-year, or dare I say, John, for Japanese 10-year in 30, unhinged from YCC, that's what the sophisticates. Jordan Rochester's looking at 147, 148 yen at Nomura.
You're right to point to the other side of the currency pair, TK, because if we are in this whole new world, and if we are going to support this stronger dollar for longer, the UK does not want a weaker pound right now, that's for sure. Europe does not like a weaker euro right now, that's for sure. And we're talking about pauses potentially at the ECB and the BOE. At the same time, we're talking about the Federal Reserve with a better growth profile doing the same thing. And yields are going to stay here for how long? How problematic could that dollar be?
There's long, and there's also breaching resistance and support. And in terms of breaching resistance on the 2-year yield, that happened yesterday decisively. And I'm sorry, I can't emphasize enough how I thought most of the media, I thought Greg Epp the last 2 days has killed it at the Journal, but most of the media has missed the seismic change of the last 48 hours.
TK, the 2-year, 5.15.
Yeah. Right now, we're going to turn to a greater look at international relations. Joining us now after huge negotiations, a professor from UCL, their Center on U.S. Politics, Julie Norman. She's agreed to be with us only because the Baltimore Orioles are this year playing 6:25 baseball. There can be things ascendant and surprising like the Baltimore Orioles resurgence, your beloved Baltimore Orioles. What's going to be the surprise in the next 6 months in the greater sphere of international relations?
Well, I love that intro, Tom. It's been a good year for the O's, for sure. For international relations, I mean, obviously all eyes this week have been on Ukraine, and that continues to be such a central point for so much of everything else we're seeing globally. You know, with the grain deal scuttled, that's affecting the global south. Obviously, Europe is being affected, and of course, the U.S. and their ongoing relations as well. At the same time, as always, we have China as the ongoing challenge, which I think in real terms is really affecting how U.S. foreign policy, how European foreign policy is playing out in so much of the world.
Falkland War, you're too young to remember this. Something happened. There was a French missile called an Exocet, and the rules changed. Are the rules changing in combat and in international relations because of drones?
I wish I could say yes. I think one thing, though, that we've seen from the war in Ukraine is that conventional weapons are still so much at the forefront of that conflict. Drones are obviously a part of it, too, and Ukraine has been obviously increasingly savvy with trying to get some access to those, but they haven't been a complete game changer. We're still relying on the tanks, the armored vehicles, the need for the F-16s and whatnot.
There's the hot war that's been going on in Ukraine. There's also the cold wars that have been going on between China and the rest of the world, and increasingly Saudi Arabia with this oil print. And I'm wondering, Morgan Stanley came out and said that Saudi Arabia is going to continue to produce 1 million barrels per day fewer outputs than it had previously until March of 2024. What's the political backdrop for that?
Yeah, so we've seen Saudi Arabia being a key energy player, obviously forever, but definitely during the Ukraine crisis. And we've seen different actors trying to use their leverage with Saudi Arabia, and Saudi, in response, trying to use their leverage as well. And so we've seen them trying to keep this production just low enough that it keeps their profits high, and I think keeps different partners coming to them for different kinds of compromises and incentives.
Some people would argue that this is actually the biggest tea leaf on China's economy, that they have conversations with China, and China orders certain amounts of oil from them. So they have insight that things aren't slowing as much as people previously thought. How much is this increasing an alliance between Saudi Arabia and China versus Saudi Arabia and the West?
Well, it's a great question, Lisa, because the U.S. is following this very closely as well. And as listeners may know, the U.S. right now is increasingly diplomatic with Saudi Arabia, trying to get an Israel-Saudi-U.S. deal. Something worked out with the normalization of relations there. That is partly for U.S., partly for Israel, but it's also partly just to counter China's influence in Saudi Arabia and the Gulf more broadly.
The little world here, folks, is we don't really know who's being booked because our team is so competent. They just get out front and do it. And it was brilliant that they brought in Julie Norman here in London. My book of the year is Robert Kaplan, The Loom of Time. You are the first person I thought of when I opened his tour de force. And the heart of his book is the American, led by Obama and Biden, certitude of the Democratic Party and the liberal elite of Washington of democracy and human rights as a template on Saudi Arabia and on the greater Mediterranean. When is the U.S. going to figure out that's not an efficacious policy?
Tom, it's a question that I think each administration that comes in, at least especially Democrats, come in with this ideals of democracy, human rights, and this plan to counter Saudi. We heard that from Biden during his campaigns and whatnot, but the reality is just you can't escape the energy situation, and you can't escape Saudi Arabia because of that. I think the Ukraine war definitely increased the necessity to have that reliance on Saudi in a way that Biden didn't anticipate, but it's one that's not going away.
Is that relationship less important to Saudi Arabia and the Crown Prince?
Well, it's important because I think Saudi is definitely diversifying their partners. For them, whoever is best for business is where they're going to go, and they're not just looking at this from a political lens. It's very economic and financial, and they have a lot of suitors right now.
I just can't point to a single decision that would be a decision that this White House liked. Can you?
Well, that's probably true. I mean, I would say for right now, they're going to keep up their efforts, but it's one that I think is going to take a while, and there's a lot of trade-offs that even within Biden's own party, I think would be hard to completely sell this.
Julie, thank you. Wonderful to catch up with you, particularly here in London. Thank you very much. Julie Norman there of UCL. Bramwell, we caught up with Javier Blas earlier this week, and I think he said something along the lines that Saudi Arabia and their tolerance for economic stress abroad had gone up, that they were far more focused on their domestic finances because of the transitions that Julie's talking about domestically at home in Saudi Arabia.
They want money, and the financials is what take precedence over everything else more than some of these other relationships. And you do wonder what this means in terms of the diplomacy and in terms of how independent different nations try to become. I think about the U.S. and I think about the output there, and then I think about the move to EVs and how uncomfortable that's been, and sort of the intricacies with China. It gets real complicated real quick.
Oh, big time. I'll say it again. We're around 90 on WTI, and we're doing this with crude production in America pushing 13 million barrels a day. It's pretty impressive, Tom. The crude is this high, given we're facing record output in the United States. Is what's happening elsewhere that's causing this.
I mean, the troops will tell me, but I believe tomorrow we have Christian Malik on from J.P. Morgan, and his arch theme is EM demand. This will be must listen if you're on Global Wall Street, like Julie Norman and I are. Christian Malik here on EM demand of oil, John, is definitive.
That conversation coming up tomorrow. Crude pulling back by a little more than 1%. WTI 88.67. Chris Turner, Global Head of Markets Research at ING Bank, is going to join us in about 34 minutes. We will not be talking about, what was that?
The
Baseball?
Orioles.
Baseball,
Okay.
the Orioles.
We will be talking about the Bank of England next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Nightly.
Stocks down yesterday, stocks down again. We're negative here by 0.6% on the S&P 500. On the NASDAQ, we're down by about 0.8. A whole lot softer here across the board. Higher for longer. Stocks down, yields up. Let's turn to the bond market and look at treasuries together. The 2-year through 5.15 earlier this morning,
it's almost
pushing
like a misprint.
5.20. At the moment, pulling back a touch
Somebody
by 3 basis
in the
points.
control room got the number wrong.
It's not
That's
wrong.
what it looks like.
514.81, Bramo. That's the big change we saw in the last 24 hours.
Higher for longer. The message is getting very clear, and people are pricing out rate cuts for next year, which is exactly what the Fed said. The read-through to that is really the question. Can you see the rest of the risk asset complex, as you were asking earlier this morning to Andrew Sheets, hang in there if you have rates that are substantially higher at a time where companies have managed to hang on to their previous financing agreements and avoid this completely?
We got to run this through. I get a lot of criticism from people that's literally stop me in bars and say, why don't you keep track of what, Chris Turner and others, what they say, what their track record is? Can we stop right now and say Bill Dudley, Mohammed El-Arian, Andrew Hollenhorst, and a good number of other people absolutely nailed this. If we were 14 months in the past, you'd look at that number on the 2-year piece like you're nuts.
Yeah.
And they nailed it.
I would go, Tom, back to the summer of 2021. Did a conference with both Mohammed and Bill, both at the same time, a conversation. And I just remember walking away from it thinking, wow, these are massive calls. Yeah. And what they called for is basically what you see on the screen right now, Lisa. 5.15 on a 2-year.
But wouldn't you think that equities would be in a very different place?
Absolutely.
Wouldn't you think that credit would be in a very different place?
Totally.
And to me, that's the big surprise. That has hung in even with rates where they are.
Even with 5% 2-year, a 10-year in the 440s, a 30-year pushing 450. That's the bond market at the moment. Let's turn to foreign exchange. 29 minutes away from a Bank of England rate decision, we look like this. Sterling a bit softer, negative by 0.4%, 122.96. Under surveillance this morning, the Fed keeping rates unchanged and signaling borrowing costs will likely stay higher for longer. In their quarterly economic projections, Fed officials saying they still expect to raise rates one more time this year, but see fewer cuts next year than they previously anticipated. Bramo, we took back half the cuts that were in the projections from the last set back in June.
This, to me, is really the message that they did manage to get across to the markets, which is higher for longer, having to do with next year. The rest of the forecasts, I think people are shrugging off and saying whatever, because basically the Fed was shrugging them off and saying whatever, we don't really know. And so I think longer term, it's hard for them to give guidance at a time where data dependency, as Jim Caron said, is basically just, we don't know.
Well, let's define people as saying. Chairman Powell said that in his conference, didn't he?
He did.
He basically said whatever.
Yeah.
Whatever. Bank of England rate decision. 30 minutes away. I'm not going to say whatever about that. Traders betting the central bank will pause after 14 consecutive rate hikes, after UK inflation unexpectedly slowed to the lowest level in 18 months. The BOJ is set to announce its latest rate decision tomorrow. We'll have full coverage on that for you, of course, across Bloomberg TV and Bloomberg Radio. For the Bank of England here, TK, this is still pretty split, but I can point to Nomura, who say no hike this morning. I can point to Goldman, who say no hike this morning, off the back of news basically that we got yesterday for UK inflation.
Yeah, though you're missing the punchline here. I had the full English today, you know, like 8,000 calories. Even because it's Bank of England Day, Lisa, I had the sausage. So young Pharaoh here takes me across to the Royal Arcade, and Lisa, I'm standing there. It's almost like where they fed tuppence a bag. And I'm standing there, and I didn't realize, Lisa, like, you know, everything here is look left, look right. I almost got run over like 3 times just getting to where Pharaoh wanted me to stand at ground zero.
This is Bank of England discussion.
I just wanted to take in the Bank of England on Bank of England decision day and how nice it was that everything was in London.
I think that's poetic, and his takeaway was he almost got ran over. But
I like how concentrated the square mile is in the City of London. There's much more of a community than, say, on Wall Street, where no one is really there anymore.
Correct.
Then the Federal Reserve is down in
I'm
Washington.
looking at Mansion House back to 1282 or something.
The
I'm
romance
tearing
of
up.
finance in London.
You know, Lizzie Burden's laughing at me. Other than that, it was successful.
We'll just carry on talking over each other, Tom. That's basically the show anyway. Stellantis proposing a new contract to the United Auto Workers, the deal offering a similar price increase and failing to give workers the clear vision of the future they are seeking, according to a union negotiator. The union's set to hold a Facebook Live event 10 a.m. tomorrow, where a lot of people are expected to announce whether more plants will join the strike. Tom, it's about whether we get a sufficient offer going into tomorrow morning to step away from deeper, more prolonged strikes from UAW.
My radar on this is up, 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 away from the wage bargain. There are these other issues. And I'll tell you, with this uproar in the United Kingdom over EV and green and Mr. Sunak, it's not that that translates over into this strike, but it just shows these other issues matter about new technology, about innovation.
Craig Trudeau here in London is going to join us at 8:45 Eastern time. So we'll have that conversation later, TK.
Joining us right now on this day of the Bank of England, quite seriously, Chris Turner joins us, Global Head of Markets Research at ING. I love, you've got a word in there, you talk about a listless euro, about we're just range bound as well. How can the governor of the Bank of England shift the listlessness today?
Yeah, well, it is split. The market's very split, whether we're going to go with a hike. ING, we think they will hike. We think the soft CPI data was driven by very volatile items, and perhaps that's a factor that the market has overread, and we think Andrew Bailey will deliver that 25 basis point hike and probably retain that kind of hawkish language. So I think that'll probably be a surprise given where the market is right now.
Explain the polarity here between a U.S. 10-year real yield of 2.07% and way below zero, taking out that huge UK CPI, is a negative 2.74 whatever percent real yield in England. Powell and Bailey, excuse me, they have 2 different worlds, don't they?
Yeah, it's interesting. Listen to Chair Powell last night about the real yield. He was asked about that and whether, for example, you know, the decline in inflation that was going to happen later in the year would mean that real yields would pick up in the US. But we don't hear too much about the real yield here in the UK.
Why not?
Yeah, I don't know. I think the focus is maybe, you know, getting the message across in terms of trying to manage like inflation expectations, retaining that kind of hawkish bias with rates staying kind of higher for longer. You know, core inflation in the UK above 6%. I think they've just got to maintain that hawkish message for longer.
John, what do they do? Raise rates 5 times?
They've been busy telling people how much they should ask for in their wage negotiations over at the Bank of England. We're just tourists here. We've got no mud to throw at the great institution across the road from this building. We've had 2 people sit in your chair this week who have said the Bank of England has a credibility problem. Do you think this Bank of England has a credibility problem?
Tough question to ask. I think probably last year, you know, when gilt yields obviously kind of blew out, there was this big sort of risk premium inserted into kind of UK assets. But I don't really see that now. I think they're probably on the fiscal side, for example. I know I'm not talking about Bank of England here, but the fiscal side has been marginally better than expected over the last few months. So I don't think we don't see that really showing up in sterling. I think it's fair to say that at the moment. I think what will drive sterling will be, it's all about kind of rates. It's all about will remain hawkish and keep rates higher for longer. And I think that's the big driving factor.
The Chancellor Hunt's going to catch up with our team in New York a little bit later on balance of power at around 5 p.m. Eastern time. Joe Matthew and Marie Hordern. Is Chancellor Hunt going to tolerate a weak housing market in the UK? It's like the most political thing going in finance, in UK economics. Everyone around every table talks about the value of their house when it starts going in the wrong direction as well. Is Chancellor Hunt just going to let that happen?
We haven't heard too much political pressure on the Bank of England at all, really. And I think the focus you hear from the government is it's all about kind of fiscal rectitude, particularly after the experience of last September. So I think they're very much focused on that, keeping the public accounts in good order.
Well, but to build on that, there's a question about the sterling strength that you see on the heels of a rate hike or sterling weakness on a rate pause or a cut. I don't understand that. If the rate pause is coming on better than expected inflation data, coming in lower than expected, allowing growth to continue, why wouldn't that be positive for the pound?
Yeah, it's currency markets in general. We know what drives them. Some currencies are driven by growth, some by rate differentials. A lot of quantitative work shows that rate differentials really kind of dominate. And I think if we did get a pause today, you'd see the money market curve perhaps adjust another 10 to 15 basis points lower across the whole curve, and perhaps sterling sell off 0.5 to 1%.
Just zooming out, we've been asking all morning why markets are not responding, risk assets in particular, are not responding more to rates where they are. The fact that a year ago, if we had said this is where rates would be, everybody would have absolutely sold everything that they had. Do you think that this is a market that has already adapted to the rates, or hasn't yet seen and realized that this might be the picture for a long period of time?
Yeah, I think we haven't talked about kind of excess liquidity, right? Which is still out there and still being unwound after, during the period of the pandemic. But I think that has been a big surprise that obviously you're talking about Treasury yields up above 5% at the kind of short end of the market hasn't corrected. But, with a prolonged period of rates up here, I mean, unless you see a very aggressive US recession, presumably risk assets can continue to grind out the gains that they have seen this year.
What's the elasticity of the British experiment? I mean, they're going to raise rates. They're going to do this. I look at where the real yield differential is with the U.S. It's just stunning, the difference in real yield right now. What can the Bank of England actually do? Can they really affect the system?
Well, you talk about elasticity, and I think one of the important things is mortgage rates, right? And the average rate on the average mortgage portfolio is about 3%. So current mortgage rates...
In the United Kingdom?
Yeah, that's right, yeah. So new mortgage rates like 6%, above 6% for the 2-year, 5.5% for the 5-year. But with like 4% of the mortgage portfolio getting refinanced once a quarter, those rates were going to be rising. So the average rate will move up to 4% early next year, 4.5% by the end of 24. So that's working its way through the economy and is still yet to be seen.
China, that's exactly what you're talking about.
Yeah, just for comparison, the effective rate in the US mortgage market right now is about 3.6%.
But it doesn't have the elasticity to move up.
That's going to climb so much more slowly than what we'll see domestically here in the UK, which goes back to the question. We're probably going to experience some housing difficulties in the United Kingdom, maybe much more quickly than we will in the United States. Is that your base case for what you expect in the UK?
Well, we haven't really seen that since like the early 90s, and I don't think we're calling a very, I think there's very strong demand in the UK. We haven't seen those sort of sharp corrections since like the early 90s. So we're not building that into our baseline, but actually turning to the US, we are a lot weaker than consensus with US growth. James Knightley, you mentioned earlier, Tom, looking at US consumption coming down a lot more than the market kind of prices on the end of the pandemic era savings being used up in student loans, and we're much more dovish on the Fed, and in general, we're much more dovish on growth.
Why aren't you baking in more weakness to the housing market with particular focus on the UK, given the fact that there is going to be a reset rate that is substantially higher and is going to make people's baseline costs that much more expensive?
Yeah, I think there is like strong demand out there. I think, for the housing sector, we're not kind of housing specialists here at IG or our
No, but it's a larger question, though. It's a larger question. When will these rates start to bite when people actually have to pay them?
So as I said, like those rate increases will be working through like new mortgages into next year. But the big thing is actually a lot more people own their homes. In terms of like mortgages, I think mortgages are only held on about 1/3 of homes.
It's a good point.
So yeah,
very good.
So they're not suffering the higher mortgage kind of rate.
Rental prices in London accelerating and accelerating. We started the week talking about that, didn't we? I think rental prices in London up something like 17% year over year.
I was on the cover of the FT
brutal.
today.
Oh, just brutal.
On the cover of the FT.
But if people own, they've moved away from this, particularly because they didn't want to be subject to resets. And so that's why if you do own a home, you're in a good spot. If you don't, oh well, you might be paying pretty high rents.
If you own a home in the City of London, you're probably doing okay. And you're probably happy rates are where they are because you've probably got a load of savings in the bank at the moment.
And you're probably renting it out to who you want to rent it out to.
Exactly.
And then collecting the income.
A different kind of trade, isn't it? Chris, thank you, sir. Chris Turner, of ING Bank. Going into this Bank of England decision, ING looking for that rate hike. Others aren't. We've named two of them. Nomura's one, Goldman's another. That Bank of England rate decision about 20 minutes away. Going into it, sterling a little weaker at 123. Alicia nailed it in the FX market. We talked about it with Arcelinios of RBC. What does a hike mean for sterling? Negative? Positive? Which one is it?
What we were just hearing from Chris Turner is that it's positive for sterling. It makes it stronger because ultimately it does follow the rate hikes. At some point, though, you have to imagine, if you go back 6 to 10 months, you remember when that wasn't the case, right? When does growth start to drive the FX picture more broadly, especially at a time where rate hikes might be viewed by some as punitive and others, you know,
and that's the heart of the matter, and I have real trouble with financial media on this. The UK economy is 1/7-ish the size of the U.S. economy, totally different makeup, and to do growth comparisons U.S.-UK is just totally unfair.
It's true. It's true.
Totally unfair.
Dan Hansen of Bloomberg Economics ahead
okay there?
on the Bank of England rate decision. A third of the way through our central banking triple header. The Bank of England up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I'm not cracking the champagne open that inflation's only at 6% in the UK. You know, it's a step in the right direction. Markets trade on the incremental data point. They're going to watch and wait, right? Everybody's data dependent. If the numbers, don't come through, then, maybe there's another hike there. But I think the base case is one more hike and they're done.
Ben Laidler, global market strategist at eToro, looking ahead to the Bank of England decision at the top of the hour. That decision is about 15 minutes away. Ben Laidler, one of a few people sitting around the table with us this week who've actually been constructive. Nice to catch up with some bulls at a time where the equity market is lower. We're down by 0.6% on the S&P 500. Down yesterday, down again today, off the back of the message from Chairman Powell. And maybe even, I'd throw this in there as well, maybe even just a touch of confusion. That was the takeaway from the Federal Reserve, because a lot of this just accelerated in the news conference. Yields up by a couple of basis points. We are in the 440s on a 10-year. We had a little look at 520 on a 2-year a little earlier this morning, and we're pushing on a 30-year, Bramo. We're pushing 450. We're at 447 currently.
When you say confusion, I think it's a really good point, especially because how do assets trade? How does a market participant trade on essentially faith in some sort of base case when you have a Fed chairman saying, we don't know? I mean, you look at those forecasts, they're sort of a guess. We could change it. We've been wrong before, and you hear everybody saying that. So where is the certainty? The only certainty you get is higher real yields, higher yields, and markets don't do well with uncertainty like that.
We all agree it's right to convey a certain amount of uncertainty around any forecast, especially in the world we're in currently. So I think we all agree with that point. What I struggled with yesterday is when you put out forecasts like the ones they put out yesterday, you have made some assumptions about some underlying dynamics that I think you should discuss openly. Because essentially what you're conveying is that your baseline, because that's what it is, your best guess, is that you can return inflation back to 2% without doing too much damage to the labour market, which is basically the experience of the year so far. You can say simultaneously, we're putting that out there with a great degree of uncertainty, but two, given current dynamics, we think they can continue for X, Y, and Z. That's what was missing from the news conference yesterday.
He should have come out and said the baseline, as you've just seen, is a soft landing. We don't know, but that seems to be what we're looking for. And the fact that he didn't raises some serious questions about the story, the narrative that he is painting around the forecast that he's leaning on.
We have very little multi-decade experience of moving from some form of peak-in rates down. We have had a 20, 30-year great moderation. And after the pandemic, we got something new here. And the fact is none of us, including the fancy PhDs at the Eccles Building, have any analog to fall back on of where we are right now. And I think their language, they're struggling with the language of it.
You could sense that struggle yesterday, Tom.
Yeah, I can. I think it's at younger institutions such as a Public Bank of England, and certainly at the ECB, that's true as well. Someone expert on this, and to give us a brief here, John, help me here. We're 11 minutes away from Bank of England.
11 minutes away. Guy Johnson's going to break that down for you.
Dan Hansen with us now, Bloomberg Senior United Kingdom economist. I was noting earlier the real yield breaking out today, a huge deal in the U.S., a positive 2%. You're doing work in an artificial fiction of a negative 2%, even negative 3% real yield. How artificial is the economy that Governor Bailey has to deal with?
I mean, it's a really difficult one for the bank. I mean, it's very different to the US. Over the past year, the UK has barely grown. So we've had very little growth here in the UK, but we've had extremely stubborn inflation, and that's really been the story. So I think moving into next year, we're actually thinking the economy could move into a recession. And that's a reflection of what the Bank of England is doing. It's lifting rates. It could well lift rates again today. But for us, the economy has been weak in